All right, welcome everybody to the next TraderLion conference. This is day one. We're going to be doing 5 days of fantastic presentations from market wizards, champion traders, hedge fund managers. This is going to be great. So first and foremost, welcome everybody. Let me know in the chat right now, actually, is this your first TraderLion conference that you're attending? Or have you watched previous years as well? I'd be curious to know. But this is my absolute favorite time of the year, favorite event of the year. It's so cool that now we actually have presenters who have watched previous ones, done tremendously well in competitions, started funds, become PMs, and are now presenting. So there's some cool full circle moments, and hopefully that's you in the audience as well in the future. There's going to be so much knowledge shared. Just take your notes, take your time, go ahead and apply it in the future, and you'll do well. Let's go ahead and dive right in. Here's a schedule for day one. Start things off, we have Jim Roppel at 10 a.m. discussing how to find and manage true market leaders. Jim is a hedge fund manager, managing over 200 million in capital, and is a fantastic educator and a lot of fun to talk with as well. That's going to be a lot of fun. Then following up Jim, we've got Peter Brandt, market wizard, fantastic performance over his whole career. And he's going to be sharing market wizard lessons from over 50 years of trading. Then to close things off, we've got Pradeep Bonde, who is the mentor to multiple market wizards, discussing his key setup, the episodic pivot, and also how to think about building a trade factory, discussing routines, discussing logistics, and how to build your trading system. So that's going to be a fantastic complement to both of these other presentations, and these all should be fantastic. So let me know in the chat, which of these are you looking forward to the most, or are you looking forward to all of them? Getting into a little bit more, this is a special event. This is, again, my favorite event of the year. It's a completely free masterclass from Market Wizards. There's going to be 5 days of stellar presentations, and our only ask for you in return is to go ahead and pay it forward, help us spread word about this resource that we're building. And to do that, the best way is to share the link to the conference with your friends, with everybody who follows you on Twitter, on Instagram, whatever social media you use. A great way is to share it on X. You can do that either by scanning the QR code right here, or also the link is down below in the description/chat. And again, our only ask is that you help us keep going and help us share this valuable resource. All right. Also, a huge thank you to our sponsors, DeepView, TraderLion, and the Trade Lab. We'll dive into a little bit about each of them, but yeah, a huge thank you to our sponsors. First, getting into DeepView, this is our charting research tool that we're building ourselves, and we currently have an excellent summer sale going on right now. You can access DeepView for a whole year for a little over $1 a day via the link down below in the description, as well as at deepview.com. You can find that annual deal. DeepView is built by traders. Most of our team are traders ourselves, and that really shows. Everything we do is focused on workflows, and finding edges in our process, and, designing around trading breakouts, finding market leaders, analyzing markets, identifying leading themes early so you're ahead of the crowd. All of that is to build into DeepView, and we're going to be adding journaling, backtesting, agents. We already have AI integration. We've got base pivots, pattern recognition, a lot of unique things that set us apart. So go ahead and check us out if you haven't already. And if you're a DeepView member already, let us know in the chat, what do you think? And, should people go ahead and check it out? Also included is a lot of educational material. I do webinars almost every single week, showcasing the platform, talking through workflows and how it can save you time. And speaking of that, obviously this tool is designed to help you be more efficient as a trader. And we actually polled our members the other day, and nearly 30% of folks said it saved them at least 45 minutes during their trading routines. So that adds up if you do that routine every single day. So if you want all that time saved, definitely check us out over at deepview.com. All right, so next up, we've got TraderLion University. This is our education platform. We've partnered with fantastic market wizards, top traders, and educators to build resources that approach trading the right way, focusing on risk, focusing on finding market leaders, First and foremost, historical analysis masterclass with John Boyk. Fantastic, underrated. He basically walks you through going from the early 1900s up to nearly the present day and discussing what created bull and bear markets and how you can spot them in the future. What themes were strong, what market leaders were a part of those leading themes. Everything is about distilling the past and showing you how you can apply it going into the future. He also discusses in depth the market wizards of each time period, how they operated, what stocks they were trading, and yeah, basically how they were able to achieve their success. So there's so many lessons in this one. It's extremely in depth. And there's a lot of guest appearances from fantastic traders as well. Dr. Wish makes an appearance. Jim Roppel makes an appearance as well. So definitely check this out if you haven't already. Next up here, I put the Trading Psychology Masterclass with Jared Tendler. He's a fantastic educator and mental game coach. And he dives deep into how you can basically become your own coach and talk you through a system that you can develop with your mental game. So a lot of people have a trading system, but very few people actually have a mental game system to avoid FOMO, to, address any psychological things that may be impacting their performance. So I'd highly recommend, checking this out, especially if you feel like that part of your game is lacking. Then we've got the IPO Masterclass, and this is truly a masterclass for multiple money managers and experienced traders, each sharing their research on IPOs, but also beyond that, just sharing how they trade. How do they find leaders? How do they enter? How they manage their positions? They present a lot of different sell rule systems that you can apply to swing trading and position trading here in the IPO Masterclass. And again, in the chat, if you guys are a student of any of these classes, let people know, what you thought of them and if you'd recommend them. We'd love to hear your feedback. Then we've also got the Stage Analysis Masterclass taught by Stan Weinstein himself. It was a privilege to work with him to create this resource. And if you're incorporating stage analysis into your process today, I'd highly recommend checking this out to kind of view Stan's updated views on how he actually trades the system. So definitely recommend this. A great foundational process for both swing and position traders. Last but not least, we've got the Swing Trading Masterclass with Oliver Kell. This course sped up my learning curve. I've watched this every single year. I get something new out of it every single year. It's like a great book that when you revisit it, you uncover new plot lines and all of that. With each new market cycle, you gain more trading knowledge, and then you should go ahead and apply or actually revisit resources you learned from in the past, because with that added trading knowledge, you'll actually learn more and get more out of those, core resources. And for me, this Swing Trading Masterclass is a core resource. Again, let me know in the chat, or have you guys taken the Swing Trading Masterclass? I know many of you are out there. And this is fantastic. Oliver shared his full system that he used to achieve almost a 1000% year. Catch market leaders, his entries, his sell rules, and also sharing, the hard parts of trading as well. So, he was, fully open with this. He's a fantastic educator and trader, and I highly recommend this. If you haven't taken any masterclass from us yet, this would be a great one to start with. So again, you can visit TraderLion.com/university and use code SUMMER for 25% any of these, or all of them if you want to really invest in your education. So definitely recommend these. I've learned something new and improved as a trader in helping create each of these, and I think you guys will as well. All right. Also, do want to mention my own service, the Trade Lab. This is something I've been doing for over 2 years now, and it is a daily market report where I analyze the markets, themes, where rotation money is flowing, and also provide my watch list, what I'm looking for, for the next day. But it's more than just a daily report. It's also plenty full of education, because I want to, show how to trade and teach you how to fish for yourself. So in addition to the reports, we have the Trade Lab Bootcamp, which goes in depth into each aspect of building a trading system. There's a dedicated webinar walking through examples, systems. So if you're still building your rules, this is a fantastic place to start. Also, there's educational articles included, a building a system course, which again, if you're building your rule set, this is a included course completely dedicated to helping you write your trading rules and refining them. Then each month we do a case study of a market leader or an additional trading concept. and dive in deep into what made BE a fantastic opportunity, what made Tesla stand out in 2020, and what can we distill from those examples, from the setups, the fundamental reasons they moved, the thematic reasons they moved, the market reasons they moved. How can we apply that going into the future? So there's multiple fantastic case studies in here, and we'll be doing each of these, another one each month. Then we've got the Edge editions, additional educational articles. We've also got a bunch of model books, Gapper model books, IPO model books included as well. And here's just where you can view the latest report in here. If you have any questions about this or are interested, go ahead and email me at richard@TraderLion.com and mention basically the TradeLab conference deal. The special deal also includes a one-on-one session with myself. So if you're interested in that bonus, that will be available for only a limited time. Definitely go ahead and, again, email me, richard@TradeLion.com, and mention TradeLab conference deal. And I look forward to getting in touch. Awesome. All right, moving on. I know I'll get this question, so I figured I'd just answer it here right now. Will this be recorded? Yes, it will. So if anybody asks in the chat, just go ahead and let them know kindly that yes, it is being recorded, and the recording will actually be available on the exact same URL you are on right now. I think actually you could scroll back in time if you want. But basically, again, the same link will work to basically watch the replay right away. And if you're part of the VIP pass, we'll also be setting up a specific place where you can watch, all the replays in a very organized fashion. Speaking of which, how to get the most out of the conference experience. So there's going to be a lot covered over the 5 days of this conference. So this is kind of a step-by-step guide on how to get the most out of it, how to stay organized, and all of that. First, go ahead and subscribe to the TraderLion channel so you don't miss anything. In addition to the conference, again, throughout the year, we do many fantastic events, webinars, interviews with top traders, hedge fund managers, and market wizards, including in-person ones. I'm doing a little bit more of those now, and hopefully you guys are enjoying those. But in addition to subscribing to the TraderLion channel, which you can do right down below, definitely go ahead and scan this QR code or click the link that's in the description right now and join the VIP pass. It's completely free, and basically that will give you access to a resource on TraderLion.com that has all the recordings in place, organized for you. We'll also put the slides in there once we've got all of them, and have additional notes and transcriptions and all of that for you, all organized, all done for you. So definitely go ahead and join the VIP pass if you haven't already. We'll also be doing some exclusive giveaways in there. So if you want a chance to win a free year of Deep View or a free masterclass, also go ahead and join the VIP pass. It's 100% free and gives you access to all those resources. In addition, I encourage you guys to engage in the chat amongst yourselves during the presentations. Be cordial, be constructive. I love to see people kind of adding value, asking questions, all of that. That's fantastic. That's the best way to get the most out of the presentations. Also, at the end of the day, or maybe after each presentation, I highly recommend sharing notes, key takeaways on X. I'd be happy to retweet any of those. So tag me, tag TraderLion, and go ahead and share all your key takeaways. Then again, watching each of these presentations once is not going to be enough. Like I said, the best trading resources are something that you have to watch multiple times to get the most out of. So just like the best books, go back, rewatch your favorite presentations multiple times. Of the presentations over the next few weeks, there's going to be a few that really stand out to you and resonate to where you are in your trading journey. So those are the ones that you should rewatch a couple times, and then maybe rewatch all of them, because you might vibe with some the first time, but then you fully recognize with more trading knowledge, this one gives the next unlock. This one addresses the constraint you're currently at in your trading business. So yeah, definitely make use of that. They're fully recorded. They'll be available and also organized in the VIP pass if you're interested there. So again, the VIP pass you can access by either scanning this QR code, or the link is in the description as well. And if you have trouble with the form, there's a secondary way to sign up just below that. So many people have been joining that we've actually had an issue with the technology. So we've got some redundancy there. So again, if you run into any issues, feel free to email us at support@TraderLion.com if you need that support, but try that secondary way to register first. Okay. I also want to call attention to all the TraderLion University free resources. So in addition to our excellent masterclasses, we also build a lot of useful and valuable free resources, from model books to beginner's guides to stage analysis, the ultimate screening guide. This is a historical study of corrections and bear markets, so you can learn what they look like and what the recoveries look like as well. We also have the podcast organized in there as well. So there's a lot of resources on TraderLion that I highly recommend you check out. Again, just scan the QR code or visit TraderLion.com and make a free account, and you can access all these resources today. All right. So one thing, and this is a little bit more personal, one thing we like to do with the TraderLion conference each year is partner with a cause or charity. So in addition to creating the conference, we want it to be in support of a greater mission. And this year, it's a little bit more personal for me because of the cause we're choosing. We're choosing the Michael J. Fox Foundation for Parkinson's Research. Earlier this year, my grandmother, Jackie Lee, passed away from complications of Parkinson's disease. Parkinson's is a neurological condition that affects movement, it affects speech sometimes, and can be very devastating for people who have it. And over 1 million people in the US have this disease. You likely know somebody who is affected by Parkinson's. So this year, if you find the conference valuable, if you've watched previous years and this is your second or third time and you find value in the past, I'd really recommend paying it forward with a donation towards our cause this year, Parkinson's Research. Even $10 is fantastic. This goes towards looking for cures, looking for treatments. This foundation, Michael J. Fox, is very highly rated as a charity and is a great cause to support. So, this can help, relatives, friends, all of this in the future. So pay it forward and, donate to a worthy cause. The way to do so should be over to the right near the chat, somewhere either above or below. Again, this is a great cause. It's personally meaningful for me. I know personally how this disease, Parkinson's, can impact folks. It can be very, very difficult. So, again, if you find value in the conference, either in past ones or today, later on, just go ahead and pay it forward and make a small donation. Thank you very much in advance. It's great that we can do, something for a greater mission as well as trading education. And this is a photo of my grandmother in the middle, and this is my mom and my aunt as well. Okay. So with that said, I also want to encourage you guys, if you haven't already, to subscribe to the TraderLion channel. Like I said before, we do a lot more than just the conference each year. So we have the TraderLion podcast, in-person interviews, tutorials, free webinars, and we're going to be doing a lot more shorter clips. I know some people, don't want to watch an hour and a half podcast, so we will be kind of creating impactful shorter clips, and post them either on this channel or our dedicated clips channel as well. So again, go ahead and subscribe if you haven't already. Check below. Are we at 200K subscribers yet? If not, you can help us build that path there. Our greater mission is to help educate traders, help them learn, risk focus ways to trade. And by subscribing, you can help us, accomplish that goal. So thanks so much in advance. And I definitely recommend it. And it's 100% free. So, it's likely going to help you achieve your trading goals. So definitely go ahead and subscribe if you haven't already. Okay. So with that said, I know that was a little bit long-winded, but thanks so much for bearing with me. This event is special. This is, we've been doing this multiple years now. Each one, I think, gets better and better. The presenters are fantastic. They share so much knowledge and lessons from mistakes they made. There's that saying that not idiots, but some people have to learn from their own mistakes, but geniuses, I'm butchering the phrase, but geniuses learn from the mistakes and lessons of others is basically the overarching point here. So pay attention during the presentations, work hard, take notes, There's going to be so much gold shared during this conference. Today especially is going to be fantastic, absolutely fantastic. I learned something every single time from speaking with these guys. And like I said, this event is special. It's traders sharing, lessons that they've learned over decades of, mistakes and triumphs, sharing their process, sharing their setups, sharing their rules, and also sharing the intangible parts of trading beyond the technicals, beyond the fundamentals, the psychological, the mental. So there's going to be a lot covered today, and also the rest of the days. So enjoy, make sure you're taking notes. Again, this is being recorded. Feel free to revisit this multiple times. And with that said, sit back, relax, and get your notebooks ready. And we'll be right back with Jim Roppel. Cheers. All right, welcome everybody to the first presentation of the 2026 TraderLion Conference. Super excited to be kicking things off with Jim Roppel himself. Mr. Bullish, he's the founder of the Roppel Report, as well as the fund manager at Roppel and founder of Roppel Capital Management, and also, of course, an extremely experienced trader. He learned from Bill O'Neill himself. There's a lot of things I could say about Jim. He's my absolute favorite person to talk stocks with. Always learn something new. And today we're going to dive into a lot. We're going to talk current markets, AI, what most people kind of miss about trading and what's important, and touch on some current leaders from this cycle, as well as some future ones as well. So this should be fantastic. Jim, first and foremost, thanks so much for being here. Appreciate your time.
Dude, I'm super fired up. Love it. Yep. Let's get it rolling, big dog.
Let's do it. So let's go ahead and start with what most people get wrong about what's important with trading. I know you had a few key principles, concepts you wanted to talk through.
So I think when I got started, I was all about the perfect base, and I still want the perfect base and the perfect pivot point and heavy leverage. And it's not that. It's absolutely not that at all. It's implementation. It's consistency. It's discipline. It's not the idea. It's how you handle it. Ideas are a dime a dozen. Okay, now you get into a pool of better ideas, which I have a couple right now that I'm so excited about. And this balance of this year, I think, is going to be massive. But the apex of the trading Maslow's hierarchy is emotional control, discipline, consistency. It's almost like I say, if you took a Wall Street Journal or Investors Daily and you pinned the whole thing up, all the pages up on the wall, and you threw a dart at it, and you just had great implementation, you'd make money. And then you include better selection criteria and a good understanding of charts and how to money manage. And that's another thing. I changed my mind. I used to say job one, number one, most important is cutting losses. And it's actually, I changed it. It's position size. Now, cutting losses is an immediate, 1A. But
a 1-2 punch, yeah.
Yes, sir. That's what I'm thinking these days.
Yeah, perfect. So how should people shift what they're thinking about as they're thinking about capturing the most out of a market cycle? They should just be focused on the larger ideas and then handling them really well. How should they change their thinking?
I think people need to understand the magnitude, the significance of this tectonic shift we're seeing in AI and innovation, and honestly, crypto as well, and AI agents, and the payments, and who's going to benefit. And I'll totally admit it, I choked on Circle. I thought Circle was the one. And I said, not only until it broke above 140, and it never did. So I didn't lose any money on it, but I got a new idea there. And I think that, I'll just say this. We have a little bump down, like we're kind of, like last time you interviewed me, the market was down too.
Yep.
But this is going to go on for a very, very, very long time. And fear is so high that AAII bull bear, it roared more bears than bulls. People just don't understand the significance of what's going on. And they're panicking out of these monster stocks that, I mean, clearly you've got to keep your losses small and things like that. But this wave is like, I'm not counting on getting another wave like this in the rest of my life. I mean, by the way, I'm 61. I think I'll be 81 by the time this is largely implemented. We have many, many tidal waves coming in. People are too myopic. Okay, they're getting out of names. They're going to change their lives. And this is just a little hiccup. But
yeah,
ideas.
So where do you think we are in this AI cycle? If you had to do it in terms of baseball, innings, and also what are the sub themes within AI that you're focused on right now and are most interested in?
Dude, we are just barely, I mean, it's probably like the first, second inning. It's so early that we are not going to come up with enough power. Okay. There's going to be some formulas that are going to change some things for bandwidth. And look, the other thing is fundamentals.
Yeah.
Okay. If you understand the fundamentals, you understand it's super early. I mean, I think people are just looking at charts, and Bill O'Neill was primarily a fundamentalist, but it's so much fun to talk about charts, and that's what the audience wanted to hear. So Bill ended up talking about charts most of the time. But when you talk to like Charles and Mike, and I talked to them less than them, but a lot, and we talked a lot about fundamentals, earnings revisions.
Yep.
Are you kidding me? These, and I underestimated. I always thought beat and raise quarters was like kind of the CANSLIM template, but the earnings revisions higher and the lack of understanding by analysts of what earnings can possibly be and their need to try and keep their job and their lack of understanding of like a TML. Like if you're a housewares analyst or a clothing analyst, you don't understand TML. You've studied a sector, but you haven't studied what really makes stocks crush the world. And so they're just way behind the ball. I mean, I'm going to overstate the case, but something like I read 2 years ago, MU was expected to earn like, I don't know, $10, and they're expected to earn $150 next year or something. Yep. That's classic. It happened with Ascend Communications 25 years ago. And around that same time, Four Systems, and almost every stock I've made, that's whether I've made money in it or not, they almost all have had that wildly grossly low estimates for the future that get revised higher. It should be part of CANSLIM.
Yep. And what are you looking for there? What catches your eye in terms of earnings revision? Is it just like blowout, they really increase it, multiple quarters of earnings revisions increases? What catches your eye? What's the magic thing you look for?
The blowout number that is 50, 100%. It's just like something like a tectonic shift happened. And usually when something that dramatic occurs, it's not going to be for a quarter. And that brings in the cockroach theory. You take your daughter to college, you look at a condo, and one cockroach comes out from the counter. Well, there's 10 more under the counter. You didn't see just one.
Right.
And so, but I was kind of myopic on that too. I even the memory names have really changed my view of what's possible. Like, again, I'm 40 years in the business. Other than like Amgen's beat and raises, and revisions higher, I don't think anything has been as dramatic as memory. I really think SanDisk is of the mature mid-cap names or bottom of a big cap. I don't think there's been a stock that I've seen. I certainly can't remember it. This one stands out.
And you mentioned TML in your response a question ago. That stands for True Market Leader. Give us your definition, your updated definition right now. If somebody's never heard of what a model book stock is or a market leader, how would you describe it to them?
So base case is 20% across the board, pre-tax margins, after-tax margins, return on equity, earnings growth, sales growth, earnings estimates, earnings beat. And then, of course, you want the other metrics, which are 99 comp, and so, but, just build a screen for those 5 or 6 variables. And and then liquidity.
Mm-hmm.
All right. CANSLIM S is shares outstanding. I just omit it. I'm a liquidity junkie. I'm running, I had 10 grand in my account or something. I need monster liquidity. I need to be being able to put $20 million to work on one idea. And I'm not even that big of a fund. I mean, I'm mid-level hedge fund. The guys who are running billions and billions of dollars, they're going to be buying hundreds of thousands of shares a day, every day for a month. Like, I'm just trying to buy, a couple 100,000 in a day.
Yep.
But liquidity, there's a magic elixir, okay? Monster earnings growth with true deep liquidity. Every big player is going to have to go there. Even though they know there are companies growing faster, the liquidity is not in some of those smaller names. So the PE is naturally going to be higher in the slower earnings growth, more liquid name. And that's look, there is no valuation in CANSLIM. Okay, it doesn't, honestly, if the PE isn't high, nothing special is happening. Now, if you're so smart and you figured it out, you're still dead money until everybody else figures out what you figured out. And the likelihood of me figuring it out is it's low.
Yep. So you mentioned kind of a lot of different metrics there. What about the kind of fundamental story behind a true market leader? What do they have to be riding to become a market leader?
Something like AI agents that have been enabled to pay for you. It's like it's like 50,000 people have actually enabled an AI agent to act for them, to pay for them. Agents are amazing, but they become magical when they can pay for you. And I have a friend who teaches AI at Kellogg in Chicago. Okay, he's top of the food chain. And I was playing golf with him and I said, hey, what percentage of people do you think will have AI agents of the 5 billion people online? And what percentage do you think will enable them with stable coins? And I said, do you think like of the 5 billion people online that 3 billion will? He goes, no way. He goes, they're all going to do it. And he goes, and they're not going to have a agent. They're going to have multiple agents. And I recently stumbled on a new idea, which I can't talk about, but it'll be in this weekend's Roppel report, of an idea, because Circle didn't work. I didn't understand the competition coming in, that it was coming. But this whole thing is going to be, there's going to be billions and billions of agents with trillions and trillions and trillions of transactions a year, like possibly like, it's not unthinkable that it could be 100 trillion transactions a year. I mean, and there's almost none right now. And this is like, it's obvious this is going to happen. It's just who's going to make the money. That's the hard part right now. Tether's not public.
Yep. So to bring you back to the question, sorry, Jim, just got to rein you in. So the fundamental story, like AI agents are like an application of this, but the stock has to be riding a theme, riding a larger innovative wave, right? That's part of what creates a market leader. Is that correct to say?
Yes, but there's different terms, durations of cycles.
Right.
I mean, there was a baby food additive that proved to make your child a little smarter. That was a very short cycle. Like, Russ was a ticker symbol 30, 40 years ago. They made pet rocks or trolls or whatever. That cycle is 10 minutes.
Right.
Okay, then you get into disruptive technology, which is usually 3-4 years, and then it's usurped. And then you get into mega trends like AI, internet, like this biotech boom that we've started. And again, I got started in biotech. That was the first thing I cold called them, loaded up and I was unaware of cycles, and I happened to hit a cycle perfectly. And then I lost all the money because it ended, and I thought it was forever. But you have to understand the duration of the cycle, the possibilities of what's going on here. Is it a pet rock or a troll, or is it the steam engine? And honestly, the steam engine, the locomotive railways, like that was not a monster. It was a monster wave, but it was brief.
Right.
This is a long boom. Knowing the duration of what's possible.
Yeah, perfect. And let me bring you back to a situation where maybe just earlier this year, we're in a correction. You're maybe mostly in cash or reasonably high in cash. What are you looking for to spot that cycle's market leaders? And maybe you could use some examples of kind of what you've traded so far this year, coming out of the correction that we had.
You're looking for the name that's, the leading relative strength line. It's possibly going to break out a day or two before the follow through day, or immediately after, like a Marvell. Oh my God! Don't make me say all this. I mean, the new high list. And by the way, right now, the new high list looks like it's expanding to me. We have a little, I'm totally segueing.
You're good.
Financials are ripping. Okay. Breadth is expanding. Russell's doing well. Housing stock. I mean, dude, housing stocks aren't coming on, but there's a lot of, because the NASDAQ advanced decline line made a new high. And that's been in a perpetual bear market for like 15 years. Like the broad market is getting good to excellent, A+ accumulation distribution on S&P, and we've got this sector that's made everybody so much money it's trying to break the 50-day. A couple of these leaders did. A couple of them did.
And semis. You're talking about semis.
Yes, semis. Yeah. Memory and semis.
Yep.
But for the most part, the broad market is, now people are going to have to adjust, because you cannot expect to catch another memory name where it's going to go up 20x in 18 months. Now, I believe we're going to see, I think we are entering, we've already entered the greatest bull market in history. I think more money is going to be made in the next 10 years than maybe has been made in all of civilization. I know that's really hyperbolic, but I just think a fortune is going to be made. And then Elon will probably be right, and abundance will be so great that money won't really matter very much anymore. The big flex will be self-actualization, not wealth.
Yep. Perfect. So I'm going to dive a little bit deeper into my question, because you skipped past it. You're good. So I put you in this situation like we had prior this year, where we're kind of in a significant correction. You're mostly in cash. And you mentioned you're looking at the new highs list. You're looking at the RS, stocks making relative strength to new highs. And then, of course, you're diving deeper into the themes behind those stocks and trying to find them. Semiconductors fit that mold really well this cycle. Anything else that you kind of think about as you're trying to search for the next cycle's market leaders?
It really, price will tell you. Looking ahead, we were in a bear market, a really bad one, like a 2-year one a while back. And I talked to my buds and I said, give me your bulletproof list, because I'm going to start buying a few of these things. And the reality was, all you really do is wait for them to show themselves. Now, the market players, the big whales who have deep research teams, are going to bid some of these names before the upturn. Yep. So they'll be off the bottom. But honestly, the first earnings season post follow through day after a bear it's like getting a cheat code on the next rally.
So anything that's gapping up, has blowout earnings, that's what you're focused on.
And you're likely to not know the name. It's likely, unless you caught a piece of it in a prior cycle, or you read about the CEO from another company that he was at, and then he switched to a new and then earnings season comes, and then they blow out. The first couple blowout numbers after a follow-through day, and I'm talking more after a 25-30% bear market, not a little hiccup like we're seeing right now, which, by the way, the index hasn't even made a lower low. We're more in a Darvas box than I don't even know how I collided bear market with current situation.
Yeah. No, you're good. So I want to ask, what does accelerating earnings or sales growth show to you? And is that something you're keying in on and as you're looking into different stories?
Yes, except for SanDisk, because I passed. Yep. It didn't have the earnings. The price was leading so much. And, you know, I know this is kind of crazy, but talking to young people, my crypto fund has brought me into a circle of very young people. I've traveled with them, hiked with them in, you know, Bryce Canyon, and knowing what they talk about. A guy named Josh Darwin, I talked to him a lot, and he builds computers. Like, you know, I think these memory stocks are really going to go up because my memory for my new build was up 400% in price.
Yep.
And I'm kind of listening to him, and I didn't really understand that he was telling me the truth. Like, that's kind of a signal. Watch, you know, and Peter Lynch said in his book, I follow my daughters around the shopping mall. Same thing as hanging out with young people, whether it's your children or other people. Follow young people. They're the trendsetters.
Awesome. I've got a lot more questions, but I think it'd be actually helpful to have some charts up as we go through it. I know you've got a few names you want to look at, so I'm happy to bring it up. Or did you want to bring it up?
You do
the chart.
Please.
Okay, sounds good. All right, give me 1 sec. Let me share screen. And which one do you want to start with here? We've got I've got them in a watch list here, and we can bring up any stock as well. And let me know when you see this.
I think I have to talk about Lilly.
Yep.
And so I said the magic elixir is heavy liquidity and earnings.
Yep.
This stock, it just embodies. It's a $1.16 trillion market cap, 51% earnings estimates this year, 22 next year, 106.7% return on equity, 40.9% pre-tax margin, relative strength 90. Let me look at. Earnings beat 22.7% last quarter. Earnings growth 156%. Sales growth 56%. After-tax margin 38.7. So those are the financial metrics. The fundamental metrics. This is a situation like they have something called the Lilly Pod. They have 1,016 GPUs, NVIDIA GPUs. They have 150 years of clinical trials, and the failed ones are as valuable as the ones that created a drug.
Right.
And now they're reviewing all of these, and the likelihood of the drugs they're going to come up with. And then they have something called Tune Lab, which allows them to partner without sharing critical data, other biotech companies. So they have like this massive incubator. And now if you look, like, I've believed in Lilly for a very long time. I've had it for my family trust for years, but it had a bull phase and then a kind of a bear phase, which really shocked me.
Yep.
And now it's engaged again. It's just emerging. So I've had this philosophy about, well, first of all, I was totally predicated on GLP, okay, the weight loss drugs. But now I'm starting to recognize how much bigger this is. Okay, this is an institutional darling. Nearly every institution that has size and great performance has it. And I just think they're going to build, and I think this is going to be a monster. And look, XBI, okay, the whole sector is lighting up. And I've been reading for years that biotech will be the first massive beneficiary of the actual implementation. And it was dormant. This is a base on base. And the market just did not embrace the theory. And all of a sudden, they're just coming out all over the place. And I started adding biotechs to my Roppel report list weeks and weeks and weeks ago. Like the first ones that came out, like TVTX and whenever, like, I had no idea the wave was going to ignite. I just happened to follow the new highs and the bases. And I am really, really, really bullish on Lilly. I always have been, but now the market agrees. And biotech too. And again, I get it. Like, I'm Reverend Jim Jones, I'm drinking my own Kool-Aid. Like I was raised on biotech 40 years ago in the first big wave.
Mm-hmm.
So I've always liked the names, but there's having great knowledge and understanding. But if the market isn't in tune with you, the market doesn't believe it, it doesn't matter. You have to wait possibly years and years and years for the market to agree.
Yep.
So I love Lily. It's a template, model book template.
Yep. So just summarizing, you've got the theme behind it. You've got this big basis just emerging. You've got over 3 billion in average liquidity on a daily basis. It kind of ticks off the boxes. Plus, I mean, it's amazing that it's got 160% earnings growth last quarter. I mean, and close to 60% revenue growth. That's fantastic for such a huge company.
And it's easy to understand.
Yep.
It's easy. Like and I'm talking about the story beyond weight loss drugs.
Mm-hmm.
Okay. People think, failed clinical trial. Well, they were worthless until now.
Yep.
And now it's a gold mine. Like everybody's like, Reddit has this huge database that they can mine. That's not even, this is the real deal.
Yep. How did you start building into this one for maybe your most recent position?
I started going after it a couple weeks back, and then it pulled way back down to your purple MA.
Yep, that's a 21. Yep.
So so the big monster bar with volume agrees. Yep. The volume signature's there, and then I just threw the hammer down. So I'm not even like in my funds. I'm not even up that much on this.
Mm-hmm.
How many how many pharmacology analysts turned biotech analysts were around 40 years ago, so they can understand, like Amgen. Like how many biotech analysts do you think looked at a chart of Amgen from the earnings report where they earned 32 cents against a penny?
Yep.
Okay. I would say there's none in the business.
Yep.
They don't understand what's possible here.
Yep. And looks like the last earnings surprise was 23%, but yeah, we'll see if in the coming quarters that just keeps increasing and increasing. Perfect. Anything else on LLY that and how it fits the template of what you're looking for too, from a larger perspective as a market leader? Anything else worth pointing out for you?
Look, if you didn't know a single thing about the fundamental story and you just looked at those metrics,
mm-hmm.
you'd be like, I don't even have to look. There's clearly something massive happening here. And then the price and volume confirms. Yep. But here's the thing. This is a whole nother part of the equation, which we didn't discuss. Confidence can only be built through understanding the fundamental story, which is going to allow you to sit through the inevitable 4 pullbacks down to the 50-day, which the average TML has per year.
Yep.
Per year. So anytime this thing gets really extended to a point above the 50 that you can't withstand the pullback down to and below the 50, you need to hedge, trim, or sell. Because Perfect. If you say, and most people do this, they go, it's only 20, 25% lower. I can handle that. And then they get in it and they can't.
Yep. And speaking of one that's been a roller coaster a little bit, so BE, I think, is worth spending a while on. Talk to me about this one.
So I was well aware of this company years and years and years ago. I got my golf pro into it. He hates me because it went from whatever, but it just wasn't ready. And then I saw the 60 Minutes interview like a decade ago, and I really understood what they did, and I believed in it. It's green. I could care less about green, but it is green. It's not bad. Behind the meter energy, but then came the need. The need came to they have the solution, but the solution wasn't necessary for a while. And now all of a sudden, the bottleneck, they solved the problem. They've got the contracts with Brookfield and Oracle, and the stock just lit up. The tape just lit up. Now, the thing is, it's probably been my biggest winner in my whole life. I'm almost certainly, I bought at the very lows of the first breakout, I bought 320,000 shares. So you can do the math. I had to sell off half the thing because it became so big. And it's
was that back in July 2025, this breakout, or on the original? This one, I think. Is that what you're talking about?
Yeah, the base looks better there. I really don't know.
Yeah.
But the thing is, the volatility that I had to sit through was unlike anything ever in my career, and it caused me a lot of heartache. I mean, you were sitting up here, you saw what was going on.
Yep.
And I really suffered through this thing. And, don't cry for me. I made a couple bucks on it, but I don't know, the position sizing was too big for me, and I had to over hedge multiple times. I remain hedged right now. By the way, closed below the 50, and it's at the very low of its range. We may be in for some tougher weather here. And I remain over hedged, actually, like delta neutral plus. But the point I want to make is you have to understand the volatility you're getting into and position size accordingly. And I was way overweighted, too much, even for a guy who's pretty much known for being able to sit through a lot. This made me miserable.
Yeah. I mean, this one has a very high ADR. What percentage of your portfolio was this, or at its max? And how have you kind of adjusted to make it, I guess, fit a little bit better in terms of what your goals are?
Okay. I cut the position in half.
Mm-hmm.
And I think it's like 40% of my account right now.
Well,
it'd be 80% of my account if I didn't let rip with a lot of it. And by the way, I am not up in my fund as much as that because I had a bunch of losers along the way.
Yep.
It's not just, I'm not up like 5 billion%.
Yep. Talk to me, Jim, about sitting with the stock like BE or just a big market leader. What can you tell people to help them understand how they need to manage the position, but also manage their own emotions and thoughts so they're able to sit with a big winner and make the most of it and not just, puke it out at the first pullback and or the first base that just resets everything.
Okay.
What are the key principles there?
No one's going to want to hear this. Make it easy on yourself and size down, because the thing is, I wanted to get rich quick, and I wasn't sure once I got into some of these monsters like that they would keep coming. Like I was not aware of the golden goose. Okay, I wasn't aware that the capitalistic system we have is going to keep promoting innovators to innovate and come out with stocks, and they're going to go public, and it's just going to keep repeating over. So it's not the only stock you're going to have a chance to change your life on. There's going to be repetitive ones. You don't have to make your whole life's wealth in one name.
Right.
If you try to do that, you're going to fail because you're not going to be able to. Price will hurt you. Size will kill you. And I really want to stress, I think I was trying to say this before with BE. I haven't learned it in 40 years. But if you just jog at a fast pace as opposed to run as fast as you can, I think you're going to live longer. Your health will be better. You'll make more money, and you won't lose your marbles.
Yep.
You won't be miserable so much. You should not have positions that are so big that they make you miserable.
Yep. And talk to me a little bit about your hedging strategy, because a lot of people actually had questions about this. So when do you kind of turn on the hedges? How do you kind of structure those? Is it when it gets extended from the 50-day? Is that kind of how you measure it? Talk me through that process.
So there's two types of level of extension. There's a level of extension before the breakout and before the first explosion up. That's going to be a muted percentage gain over the 50-day. Post first breakout, you need to be ready for that MA extension to go multiples of what it was before. And on the first run up, you don't know because it hasn't pulled back yet. So you have to eyeball it, time and duration, what looks like. And well, the other thing is, you don't even have to know what the max level of extension is going to be. What you have to know is what you can sit through. So it could go well beyond that level. But once it gets into a zone like where it's historically pulled back, I will sell calls in the money as deep as I can, and then I'll start with like 30%, 40, 50, and I'll build. The more it goes up, the more I'll build. I found that initially, I used to be so bullish, I'd hedge 15%. Well, that's nowhere near enough. I think I need to be hedged 40, 50, 60, 70%, and like right now, in the case would be 100% plus. Now, this is the big thing. People don't understand this. It is not meant to be when you put a hedge on, you pause the seasoning for long-term capital gains. That is paused. So it's a tool to get you there, but you need to understand that it's going to delay your 1 year.
Yep.
And I try to sell them down to around the 50-day. I don't believe so few stocks hold the 21-day. Like, I honestly didn't even have a 21-day on my charts until like 5-10 years ago. It's 30 years with ignoring the 21-day. I used to be like, dude, back when I started, most stocks never held the 50. Forget the 21. And that is a sign of the times we're in, that this bull market is so whacked out strong that stocks are literally riding, and abundance of stocks are riding the 21-day. That's not normal. Nothing about this market is normal, because nothing is normal about the significance of this innovation. When you have something that's this life-changing, this extreme, you have to expect those kinds of extremes in levels of extension, in price moves, in duration of move, in wealth creation. Everything is commensurate to the level of change the innovation brings.
Perfect. And to ask a follow-up on the hedging, so basically it's whenever you think a pullback is imminent or it's kind of in a basing period, you kind of apply the hedges, and when it re-breaks out, you kind of take them off to keep working the long-term capital gains. Is that in general what your goal is?
Very broad. It is far more of an art. And the art is, where do you take it off? It's clear where you should it's clear what my pain threshold is that I can take in a pullback. It's clear when it's reached a max level of historic extension. Where do you unwind it? Does it come down to the 50-day? Does it undercut it by a few pennies, $5, 5%? Or does the thing break wide open?
Right.
How do you know? You don't. It is art. It is waiting for support. It's not like a math problem. 1 + 1 could equal 13 when you're trying to just do this, not 2.
Perfect. All right. Anything else on BE that you think serves as a good example? Is there anything about the fundamental story that also like really caught your eye and made this opportunity kind of stand out to you?
To the best of my non-technical ability, try to understand how big the market share can be and the total addressable market. Well, I just felt like this one was infinity. Like, I've never seen something so broad. I mean, AI agents, I don't know what's bigger.
Perfect. Awesome. So let's talk Marvel now. So talk me through this one.
This is GPUs to CPUs because of AI agents, and it was like right around 100. Again, I'm going to pull up my Wanda so I can go through the numbers with you. SRVL. So what do we have? 33% pre-tax, 17. Now we have, return on equity, 17.8, almost 20%. 43% estimates this year, accelerating to 53% next year. Almost certainly, they're supposed to earn 618. They will beat that. Last quarter earnings report, 29%, sales growth, 28%, after-tax margin, 29.7. I mean, and the story is everybody thought GPUs was the whole thing. And now all of a sudden, because of agents, everybody recognizes it's CPUs is CPUs. And these guys are in the sweet spot. Now, note, the stock pulled back right to the 50-day today, and it undercut it by a smidge. Look at the volume since its high at 324. It's gone down almost every single day. This is as good of a volume signature as you can get in a $200 billion market cap. It has the fundamental story. It has the fundamental metrics. It has the liquidity. Traded 34.5 million shares today. Average daily volumes 46 million a day. And it is an institutional darling of who holds it. Up to down volume 1.6, comp rating 98, earnings stability 20. It's A+ accumulation distribution 98 RS. And here's the thing: you get a name like this with these kinds of metrics, like a Lilly, they're almost always extended. It's a rare occurrence when you can catch a name like this around the 50-day.
So how are you watching this one now? Are you just looking for it to build out this base and maybe potentially add as it starts setting up again within the space? Or at this point, are you just holding your position and keeping an eye on it?
Okay, I'm hedged really big in this thing. I will wait for full-blown uptrend, not just support, but a new uptrend fledgling. I mean, I might unwind a little bit, but the semiconductor is cooling with the memory names across the board. A couple of them broke the 50, but this is going to need time. I don't think this is going to come back tomorrow.
Yeah, here's SMH. I just brought that up. And it's wider and loose too. How have you kind of interpreted the last few weeks in the semis and hardware?
Well, there's a lot of climactic action also, and full-blown climax runs. But oddly, NVIDIA was up today.
Yep.
The Mac Daddy, which has been a slug
on the 200.
Exactly.
Yep.
Now it's also been living well below the 50-day. That is a no-go. I mean, look, again, I have some, but I've held it in my fund for 2 or 3 years or more, and like I'm not getting out of that. Well, let me back it up. If it were to start living below the 200, well, I lived through it below the 200 many times already. But this is as it was a signal that not all was well, today could be a fledgling signal that we could be nearing the end. And a new cycle could start with new names. And by the way, there's been a lot of new names that have come out. I can't talk about two. I just registered with the SEC, but there's a couple names out there that really, really have my attention. And
what do they rhyme with? What do they rhyme with?
One of them rhymes with Bell.
There you go. I won't bring it up, but yeah, sounds good. Cool. Anything else on Marvel that you think is really worth explaining? This is another one. It's respected the 21 multiple times until this base. So that this is kind of the first break of the 21 since that breakout. Does that tell you it needs a little bit more time to consolidate than maybe normal?
It's a little bit of a personality change.
Yep.
Like Intel broke the 50 today.
Yep.
Well, again, volume was low on a lot of these names.
Yep.
There were multiple names that I watched closely that were down 30, 40, 50% in volume today. Now, that also in 2007, I was up like 230%, and the market rolled over and volume didn't come in, and it didn't come in, and it didn't come in. And then all of a sudden, after things were down like 30, 40, 50, the volume waterfalled. So you still have to protect. You don't know, is the volume low because no one's selling and it's no big deal? Or is it that it's just started and the volume's going to waterfall in later? So I took a 230% year and I ended up like 130. I mean, so you have to act as if possible worst case scenario could unfold, but remain bullish.
And for Marvel and a lot of the semis, what would have to happen for you to kind of see that they're progressing within their bases and getting ready to break out again? Are you looking for tightness at the bottom of bases, expansion up, reclaim of the short-term moving averages? Well, first and foremost, respect to the 50, reclaims of the 50. What are you kind of looking for to say, okay, these bases look mature enough to start another leg higher?
Dude, you know this system really well. Everything you just said, like
Yep.
TNT, tightness in time. And then a triple T, trend will turn up subtly. You'll see accumulation. But dude, the volume just drying up, not evaporating, but it's consistent. This is not really illustrating the dry up in volume. That keeps me bullish.
Perfect.
But you know this so well. You just rambled everything I would have said.
Yep. That makes me feel good. So let's talk maybe a few other names. We mentioned SanDisk earlier. How great a stock has this been? I mean, what a move. And it started back in here. And this is obviously a recent kind of reissue. This is the first leg up. I think this is where a lot of people start focusing on this name. How have you interpreted this move? And I know you mentioned it didn't quite have the metrics that you were looking for at the time. Now it's got that tremendous growth. What are your thoughts on SanDisk and what should people should take away from this name?
My biggest thought on SanDisk is it's a stock that I should have changed my life on, and I barely made any money on it. I mean, and one of my hedge funds does have a position, still has a position. But I think the bigger lesson is the big monsters will go wildly farther than anyone thinks. They will give you multiple opportunities to get in, but Webby and I were talking about this a lot on X, that Bill wouldn't have been in it.
Right.
And I'll tell you about one of my faults. I am too rigorous in implementation. I don't bend rules enough. Like, I should have more exceptions, because I clearly was looking at this on the first. The big signal with this was the very, very first breakout when the earnings weren't there. The violence and volume were clearly telling me, like, I should have gone, look, it's too unusual. I need to override the lack of earnings. But that's kind of like one of Bill's like number one things. Like, he almost never violated that. But the volume coming out at like 40-ish down there, whatever it was, it was, you need to look at it on a different scale. It's so enormous. It's just look at that.
The increase in average volume. Look at the moving average increase. Boom. And look at the closes these first 3 weeks, Jim. Look at that. Boom, boom, boom. What does that tell you about institutions and what they're doing?
Unrelenting buying. They know their lead semi guy at Fidelity goes to Magellan, and he tells them, the guy says, "What's your favorite stock?" And then he goes down to OTC fund, and then he goes to whatever. He visits every office, every portfolio manager in the complex, and before you know it, they all have it. Okay, those guys, when they buy, they're buying for 2 to 5 years forward. They're not trying to flip, their position for 5 points. They're in, and that's why it catches even more support around the 50. And then you had the next big base that came in. There was a real legit secondary base. Are you on a weekly?
I'm on a weekly, yeah.
I'm so out of whack. The handle was very, very nice in the end of that. It just doesn't look. If you look at the daily.
Yeah, I'll look at the daily, and here it is, right here.
Yeah, look at that 1, 2. Look, I mean, it just, and a lot of people they're just like they are now. They're like, it can't go higher. There's so much negativity that no one can believe it. And people in general think AI is a bubble. And it's just, if you understand the fundamentals, it's nowhere. We will have full-blown bear markets, like broad-based S&P bear markets over the next 10, 20 years. And these stocks will come down, but like this is no bubble. Dude, the PE's down on the S&P and earnings are up huge. I mean, the market's just become cheaper, and these names, many of these names, earnings are up way more than the stocks are up. And the fact that no one believes this is real or that it's going to persist means it's definitely going to persist. And the opposite occurs at Tops. Tops people are like, I'll just take a mortgage against the house. Let's, sell our farmland. They're looking for money everywhere. They're all bullish. They're all, in the top in 2000, this journalist called the fund manager, and he goes, I'm really, really bullish. I think the market's going to go up another 20% this year. And the journalist says, we're not going to run the story. You're not bullish enough. Like, the public is salivating for these monster price targets. And that's top talk.
Right.
And by the way, when it first starts, it's the beginning. It will persist for months and months and months and months. It'll be a fever. Like what we saw in memory will grip the whole market, and the broad market will likely climax, which what's the NASDAQ up 10, 12% this year? And
right.
The mutual fund index is up like high single digits. Like, I mean, when the odds of a climax run around the end of the first monster wave is, in my opinion, it's 85, 90%. And we're not even remotely close.
Talking about SanDisk a little bit more, this is the first, we've had a few tests of the 50-day, 10-week line. This is the first, this looks a little bit weaker than the past ones. how would you expect this to resolve? Does this need a bigger base to build out? What are the possibilities in your mind? Obviously, anything can happen, but what are your expectations? What would look like healthy action, even as it pulls back and continues to base?
Well, first of all, this thing had 2 climax runs.
Yep.
And now it got, you already called it out. It was loose at the top. Many of these names, the monsters, were just all over the place. You've got a key leader, Light, has been living below the 50. What else? We had multiple climax runs at like GLW climax, AMAC climax. Dude, I could name 10 of them.
Yep.
So the loose action, the climactic action, the move is not new, but look at this thing rallied into the close. How is it going to handle the 50 days? How it handles the 50-day, that's the guardrail. Mm-hmm. That's going to really tell us a lot. But the fact is, this looks to me like it's going to need time.
Mm-hmm. Yep. And
how long? Yeah. The price action will tell me. I have no clue.
Yep. And then MU, its sister stock, both of those kind of topped on the MU report. That was the greatest earnings report we've ever seen. And by the way, this bar means accelerating earnings growth. So look at those. Look at those quarters.
Acceleration there. What was the number?
It's 167 to 882 to 1214.
Yeah, I don't think the world's ever seen anything like this.
Yep.
I'm wowed, but this is not the broad market.
Yeah,
the broad market's catching action. I think this is a split tape, and I'm super bullish for the second half of this year. I think a lot of money's going to be made. I think a lot of career years will be had this year. And I don't think these names are over.
Yep. What are there any other names worth watching? Oh, somebody actually asked a question. What was your biggest mistake that you think you've made this cycle? It may have been SNDK. You kind of mentioned that. And what did you learn from that mistake?
I underplayed it, and it's what's hilarious about that is people heckle me on X. They're like, he's a permabull, ignore him. He's way too bullish. The biggest mistake I made was I wasn't bullish enough. I also over hedged. I was in multiple stocks that ran 10, 15, 20, 50 points in my face. Hedging dampened, and they did what they were supposed to do, but I was, as bullish as I was, the names just went wildly more higher than I expected, and it hurt my results. I had a very good year. We talked about it before the show. I'm right in line with you, which is most people call that almost a career year. Okay, and I'm whining.
Yep, perfect. So what are your thoughts the next few weeks, months? What are you kind of watching for? What are your thoughts kind of right now?
I think biotech is absolutely the new leading area, really benefiting from AI, and I think that's going to carry the torch. While look oddly, I've been watching this name. I mean, I think this was actionable probably today. I wouldn't buy it, but for a trader for sure.
Yep.
But you look at XBI, it's extended.
Yep.
Okay, it's like 18% over the 50-day, and the prior biggest extension was nowhere near that. Like it was like 14% or something. I would suggest, I'm probably too bearish, but it looks like it needs to digest. Okay, I've hedged part of my position, and I just think biotech is going to roar while electrical memory chips are going to digest. And I think the broad market, like financials, look at XLF. I mean, this is really bullish. I mean, isn't 30% of the S&P financials?
Something like that, yeah.
Slug. And, I also think interest rates are, with AI causing massive deflation and oil broken terribly lower, it's hard to... Okay, I'm going to tell the market where it's going. The key thing you should never do, I do not see rates going that much higher. I mean, could it happen? Of course, the market expects it to. I'm betting against the odds here that we're not going to see. If we see rate hikes, I don't think they'll be big. And I think you're going to see a broad market rally. I think the Russell is up 22% for the year. I think it's going to lead. I think biotech's going to run hard. So biotech totally extended, but it's early in this run. It just started out of a base on base breakout. I would not be shocked to see biotech run for 2 years at all.
What thoughts? Because historically, I've kind of avoided biotech because there's like the added risk of like when trials come out, all this stuff. What guardrails do you keep in mind to trade the more institutional quality ones? Obviously, you never know what's going to happen, but what things do you think about to try to trade the highest quality ones?
Okay, you hit it right in the head. It's biotechnology without FDA approval is a cash burning laboratory with no product, no sales force. You're completely dependent on successful clinical trials. Pass it up. Go only with the names. Either buy an index or buy the profitable names. Because I learned the lesson of a lifetime. I'm just going sidebar here.
Yeah.
Can you see this? Is it say,
yep.
Where is it at? Up top.
Yep, up top.
Centicor plunges on FDA decline. I had a stock I spent a year cold calling. I built this massive position in Centicor. Soros Fund Management had a position, went from 18 to 80. The FDA review committee tells the full FDA they granted approval, or they recommended for full approval. And then the full board said they declined it. And the stock, it just imploded. And I burned a whole year's worth of cold calling and opening accounts. And that was a year's work lesson because I lost a fortune. I lost half my book on it. So this reminds me of single drug non-FDA approval early. So you can make a look at, you really got to ramp it up. Look at LABU.
Yep.
All
so
right.
That's the 3X biotech.
It's the Soxil for biotech.
Yep.
Now it's totally extended, but broad-based, if you have a stock that fails in the middle of a clinical trial, expect it to go down 70, 80%. Now, if a leading biotech has a failure like that, the broad market of biotech is going to go down 10, 15, 20%, maybe, but the individual name is going to get obliterated. So you hit the nail right in the head.
Yep. And LOY is hopefully about as institutional quality as you can. And I think there's a LLYX actually, if you need, with all the leveraged ones. Are you trading this one? Or are you trading LLY? How are you? Yeah.
Straight up LLY. I mean, I have to tell you, the reason I've implemented a lot of hedging is I'm just not up for the volatility like I used to be. I mean,
yeah.
Lilly will not be the biggest percent gainer, but it will be probably the most palatable ride, and it will provide more than enough high octane for the average person. Even, some position size is everything for your risk taking. But I'll tell you this: if you have a stock and you think you have this, what your best idea needs to be the biggest position in your account for your risk tolerance. If you're really that sure. The list of shame is IBD's top 100 performing stocks every year, because I've been in most of those names many times and I didn't even come close to making the names. Now, when you know it, you know what the fundamentals are. You expect it to do this. You should make it your biggest position, and if you get shaken out, you need to get back in it.
Yep.
So don't make New Year's Day a shameful day.
Yep. One more question about AI. We've talked BE, which is kind of AI energy requirements. We've talked Marvel and a few other semis. That's kind of like the infrastructure around agents, AI. We talked LOY, which is the biotech. Any other angles to the AI overall theme that you're really focused on and learning more about each day?
I have two of them. I just can't talk about it.
Okay.
But you don't have to.
Yeah.
You don't want to hear me.
Yep.
You do not want to hear me tell you. What you want is to be able to figure it out for yourself. You need to know the method that agrees with you. And the new high list it's a guarantee. There are no guarantees in life except this one. If a stock's going to go from 1,000 to 5,000, it 100% has to be on the new high list all the way up. It's impossible for it not to be.
Yep.
So I could tell you the two names I love, but you don't have to know them.
Yep.
All you have to do is screen for RS earnings and new highs, and you cannot miss it.
Yep.
Now, you might pass on it because you don't like it, or you're not ready, or you're too bearish, but the name's going to be there.
Yep. Can I ask you about software names and how you think they're being impacted? Cyber has been showing RS recently, DDOG, CrowdStrike. Any thoughts on the software space and how AI will kind of impact those?
AI is the reason. I mean, AI is going to find holes and flaws. And I mean, yeah, AI is causing this as well.
Yep.
FTNT roars.
Yep.
But I mean, again, I want to be in the liquid. I want to be in the most liquid name with the highest earnings growth ratio, the magic elixir. So I'm looking at, I would be a CrowdStrike. You're really heating up around my favorite name.
Well, I won't try to guess it anymore. Jim, I asked Twitter for a few questions, so I've got some rapid fire ones for you. Let me go ahead and stop sharing here. So I asked what your biggest mistake was. Another really good question I thought was good is, what lesson was the hardest to learn or took the longest to internalize? And that could be just about markets. It could be something you learned from Bill O'Neill. Basically, what lesson was the hardest for you to learn, and how did you eventually internalize it and apply it?
Position sizing. Back in the day, early on, I had very little money, and by the way, back then you could use, it wasn't 100% margin, it was 200. 100 grand carries 300,000. And I was too levered up, didn't really care about fundamentals that much. I was far more technical back then. I didn't understand so much. I didn't understand about liquidity, and I barely even understood earnings beats. I mean,
Yep.
Experience. I didn't know what I didn't know.
Yep.
Experience. You should spend more time reading about your stocks than you should watching the tape. I was sitting here at this desk today. I was in the other room watching a podcast. I come in here and I almost made 3 trades in like a 45-minute span. I'm like, what am I doing?
Yep.
I shouldn't even be in here. I watch too much. The evolution of a trader is trading less. I don't know a trader who trades more as they get more experience. They trade less. Every single one I know. Now, there's probably a few, but I sacrificed quality for chart. I was not selective enough. I bought anything that broke out. I was really, what kept me in the business and shocked me and stunned me was I didn't realize that like 80% of hedge funds fail within 5 years and most of them fail within 2 or 3. I stayed afloat for 40 years. Of the first 5 years, I was a mess. Boom, busted a lot. But after that, I stayed together because I cut my losses. I am astounded that I survived, but it's all in the 345, 357, cut your losses. There's 2 things. There's losing your money from cost, and then there's giving back profits. Both bad, but one is detrimental to your health. One's existential.
Yep. Perfect. There was also a question, and these are supposed to be quick fire, Jim. Just FYI. No, I'm kidding. Take as long as you want. There's a question about what separates constructive action around the 50 SMA versus action that would, put the warning signs up and set the alarm bells flashing for you. So how is a stock that's being supported act at the 50 SMA versus one that's under distribution?
Okay, I'll tell you how it's not supported. If it comes down straight at 6 o'clock in the clock face, by the way, volume does matter. And if the volume's ripping, you have to cut some. Now, if it comes down and it glances at say this is the 50 and the stock comes down, it just softly careens into it. That's not a panic situation. Actually, some of the biggest winners I've ever had held tight just below the 50 for 3-4 weeks. And they're tight down there. Now, a Friday close or a 5-day close below the 50 for, is going to really rattle me. If it's down more than say 3, 4, 5%, that's about the most I can take, the percentage off the high. Now, again, the level of extreme above the 50 made the pullbacks down to the 50 a lot greater, but historically, I would say 23% off the high and below the 50 is a problem. But you have to open that up because conditions have changed. It's kind of like the percentage gain on a follow-through day matters with volatility in the market. The amount off the high that you need to be tolerant of has got to expand in this condition. But the Friday close, 5-day, 10-day close below, how far below? How does it breach the 50? Does it breach it? And look, I love Webby, and he does have valid points about dirty data on volume. But when a stock pulls back like Marvel and the volume just dries up every day, I can't ignore that. When it breaks the 50 and volume explodes, I cannot ignore that. I will ignore price action that's very bullish without support. But when you get the volume, I have to acknowledge that. That's real. So we agree and we disagree.
Yep. And then
guess what? We both can make plenty of money. You can totally disagree and still make money.
Yep. And then another good question is the last quick fire S1. How important is the relative strength line for your process, and do you like or how much do you care if the RS line is making a new high before the price breaks out of a base?
A lot. Now, I would normally say that I only buy stocks with RS in the 90s and generally high 90s, but there's a couple names I'm looking at that are emerging. As long as it's coming out of a good base and the line, the angle of ascent on the RS is going to keep me. I generally don't fool around with low RS, not low S, below 90.
Yep.
But when you have an emerging sector that you've been watching that starts to catch traction and a name pops out, it's early, it's likely to be the leader, and the RS might be in the 80s. So I'm oddly, somehow I was not flexible with SanDisk, which would have changed my life, but now I'm going to be a little flexible with this.
Yep.
But I still have integrity in it, that it's got to be leading.
Yep. And
what was that for quick? That's about as good as you're going to get.
Yep. Sounds good. Perfect. I think that's pretty much it. I know we're coming up on time. Where would you point people to for resources to help them learn your style? And, you know, if they want to learn more from you or reach out to you?
I mean, I write the Roppel report. I put all my best ideas in it, and I teach you. In other words, if I die, you'll get it. Like I'm going to give you life lessons every week. I answer all your questions every Wednesday afternoon after the close, and I cover everything you need to know to implement CANSLIM. My wife says use the discount GOLDEN for. Buy the bundle, put Golden in, and you're going to get some discount level. I'm not sure, but you know, I learned from Bill, and Bill, he did not care about money. He cared about changing the world and helping people learn to trade. I'm not afraid to make money at all, but I do love to teach. If I wasn't doing this, I would be a teacher for sure. And I love to teach every Wednesday. Open video every other Sunday. I put out a full report with charts of every stock I like, pivot points, sector analysis, all my commentary on my best thoughts, and I'll teach you how to trade with just the way Bill taught me. Except I only got to talk to Bill like, once a month or less, and you get to hear from me like 5-6 times a month.
Perfect. And one last question to kind of wrap things up, Jim. If someone watching this could take away one thing, what is the most important thing to remember from everything you covered today?
If you screw it up, it's chill. You have to know why you screwed it up, but there's going to be another golden goose fast pitch. They're just more Blackberries, more McDonald's, more General Motors, more airline stocks are starting to take off. Don't worry. Socialism has not suffocated capitalism just yet. I suspect we're going to have decades and decades of more fast pitches. Believe in yourself. Anybody can do this with discipline. If you don't have any discipline and you're a Yahoo, you're going to fail. But anybody can do this if you really apply yourself. You can get rich beyond what you thought was ever possible when you were a kid. You can live the dream. You can become the dream you had when you were young. It's totally possible. I've seen it happen to hundreds of people, and
Perfect.
it'll never stop.
Perfect. And I lied, Jim. I got one more question for you. I wanted to hear your thoughts on SpaceX, just kind of what you think about that situation. Obviously there's a very new IPO, but what are your kind of thoughts with here and this whole situation?
My daughter, we go on vacations, and she's like, I want to bring my boyfriend. And I heard this woman, she goes, no ring, no bring. Well, how about this? No base, no buy. Okay, it's 1, 2, 3, what do we have? 14 days of trading? Where's the 7-week base? Where's the cup and handle? There's no pattern here. No ring, no bring, no base, no buy. It doesn't have earnings. It's made a lower high, threatening to break lower, immature. I mean, look, Elon Musk has made a lot of money for a lot of people, but it would be a cowboy move to buy this over 172, over the high black bar.
Yep.
I mean, you would be buying a 3-week digestion. 97% of IPOs undercut first day close within 1 year. Elon Musk is probably clearly the Thomas Edison of our time, done more for human society than any other human in the world. But this stock has no seasoning. Look, if this ran up to the highs at 230, 227,
yep,
handled for 2-3 weeks, even without earnings, I would probably go after it. But this is just, how much of a cowboy are you? All right. Every variable in CANSLIM you sacrifice, your odds of failure go up. This is just an immature IPO.
Perfect.
Can you hear the landscapers cutting all the trees?
A little bit.
This means we're finito.
We're good. We're good. I just want to throw that bonus question at you. Jim, always a pleasure having you on. Thank you so much for your time. This is great. Everybody watching, I hope you guys enjoyed as well. There's a bunch of quotes that I wrote down, and I look forward to watching this back shortly. But thanks so much, Jim, for your time. Appreciate you. And we'll be right back. Cheers. Okay, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Peter Brandt. Peter, many of you guys know him. He's a market wizard. He's a futures trader. He's been doing this for now 50 plus years, I believe. Peter, is it 51 years now that you've been trading?
I'm in year 51 right now.
Congratulations. Has tremendous performance. And today he's going to be sharing a lot of key lessons for everybody about how to approach trading as a business, focus on risk, focus on position management, and the key principles to be able to trade for decades. So Peter, first and foremost, always a pleasure to speak with you. Always learn something new. So thank you so much for the time. I appreciate it.
Yeah. Hey, thank you, Richard. Thank you for doing this too. I just think I participated in this for years because I think it's really worthy. What you guys are doing is really important. You have some great traders on who are not necessarily pitching something that they're selling, but they're really trying to share exactly what it looks like, the whole business of market speculation from where they sit. And that's what I want to do. And, 50 years, when I combine my age with the number of years I've been trading, it adds up to 130. I doubt that there's anybody out there in social media who can produce a number larger than that. Actually, I asked that question on Twitter a year or two ago, and there was one gentleman that had me beat by years. So, this has been my life. And, I'd love to be able to share for those of you who are maybe just starting out. You've been trading for 3 to 5 years. You think maybe there's some hope. You're starting to gain traction. You're trying to figure out what your problems are. In the case of somebody who's just starting out, they don't even know what questions to ask, really. They don't even know exactly how to identify their problems in order to correct it. And so I'm glad to be able to share my journey, because maybe there's something in my journey that'll connect with you. And it'll be an aha moment where you say, okay, that's really important information. That's something I can use. So I just kind of want to identify myself and walk through what I've been through as a trader. I made my first trade in 1974. There was a futures contract for bags of silver coins that were minted back in the days when the higher silver content in quarters, half dollars, and so forth. That was 74, and I actually made some decent money on it. Now, I wasn't in futures at the time, but when I look back now at my time in futures, I go, "Holy cow! I've been a trader in the presidencies of Gerald Ford, Carter, Reagan, Bush Sr., Clinton, Bush Jr., Obama, Trump, Biden, and now Trump again." And so I've seen a lot as I pass through this journey called futures trading. I want to just kind of cover some of the things. A little bit about me. I don't want to spend much time, but just to give you a perspective of how I ended up on the Chicago Board of Trade. I grew up in Minneapolis, Minnesota, to a single mother, divorced dad. We're a welfare family. I had to learn to work from a very early age. As a matter of fact, I had to figure out what I was going to make to buy my clothes from age 13 on. And so I knew what work was. I was also a fairly good athlete, and I played Division I ice hockey in Minnesota. Graduated from University of Minnesota with a degree in advertising, and that is what I thought I was going to do for a living. We moved out of college, my wife and I, and one child at the time, to Chicago, Illinois, to work for an ad agency called Needham, Harper & Steers, which is now part of the Omnicom Group, largest ad agency in the world. And my son was playing ice hockey too, little kid ice hockey in Evanston, Illinois, at the Robert Crown Ice Center. And the dads would sit around and talk about what they do. And I'm in advertising, and I got these clients. And there's a dad that goes, hey, I'm a soybean trader. And I go, what the heck? What is that? I joined the Chicago Board of Trade, of course. And John invited me down to the Board of Trade. Come on down, and I'll buy you lunch in the 5th floor members' dining room overlooking the floor, which I did. And I was absolutely captivated. it went down a couple more times, and I was just enamored by the fact that here are these guys that are yelling and screaming in a pit, and this is how they make money, and they don't have to report to anybody, and they don't write memos, and they don't sit in meetings, and they're off at 1:30. And, the guy that worked hard all his life, I thought it was, fair intelligence. I knew I was a hard worker. I just felt like, what a cool job. How cool would it be for me to make my living as an adult, and I was mid-20s at the time, by trading commodity futures? That's a crazy idea. And so I ended up getting a job with Continental Grain that paid me a very small amount of money to try to bring in clients to use Continental Grain. They were a competitor of Cargill at the time, for which I'd be paid a fraction of a cent as a referral. And so I had an opportunity to make money. My real goal was to learn how to trade. I wanted to become an independent trader. Right from the start, I wanted to be an independent trader. But I had to figure out a way to learn the markets. I didn't really know what a futures contract was when I entered. And I had to learn everything. I started from the bottom. I would bring in clients. Again, my goal was to trade, and Continental would let us trade our own accounts. We'd have to put in, and I can't remember, $10,000 or $15,000, and then they'd let you trade that account. They'd monitor it closely, make sure you weren't, putting your orders in before you're putting a customer order in. And I tried everything. I tried trading fundamentals, macro, spreads, point and figure charts, cycles, seasonals, and I would blow accounts, and I'd start another account up for $15,000, and I'd blow it. Another one for $15,000, I blew it. And I had come to the point where I was seriously thinking about going back to advertising. About 1978, now at this point, I'm 4 years after my first trade, and I'm thinking, I'm not sure I'm going to make this. I have not figured this out yet, and I'm 4 years in. And in 1978, late, a friend of mine brought me over to the Board of Trade bookstore and bought me the book, Edwards and McGee, the 5th edition, Technical Analysis of Stock Trends. I read it in a weekend, and it just resonated with me. And I went, I think I know how I might want to do this. And so I became a classical chartist. I started an account to trade classical charting patterns, and by the end of 1979, I had my first profitable year. And the profits became good. 79, 80 was a good year. 81, I split from Continental Grain and formed my own trading company, Factor Research and Trading at the Board of Trade. Traded at the Board of Trade to 1983, at which point I felt I'm successful enough that I think I can trade off the floor. I think I can move, and I wanted to move my family up to a lake in northern Minnesota where I had been raised. No street lights for 15 miles, and trade from there. And there were a couple of things that happened in 83 dealing with brokers getting brokerage commission when they're off the floor, plus the satellite dishes from commodity called graphics really allowed me to flee Chicago and go to where I wanted to trade, which was up in Nisswa, Minnesota. And this was an article in 83 that had been putting in a small satellite dish, the CQG dish up in a lake. And that was what was kind of the business. And then, I got hired some people, so I actually had to get an office building and this is back in, the late 80s, early 90s, a time in which, I was trading fairly big numbers at the time. I, at this point, might have been trading a million corn, a million bushels of corn, 100 gold, 100 bonds. And that was both for myself. I've never handled customers. I don't trade OPM, other people's money, or I was trading a proprietary account for Commodities Corp, which there's never been another Commodities Corp other than Commodities Corp. They're in Princeton, New Jersey, and they would test you out with an account of $35,000, and depending on how you go from there. But you got to remember, back in the 70s, the markets were not like they were right now. Let me tell you about what it was like in the 70s to trade. We had no computers. We didn't know what computers were. We could not print out charts. We kept our own charts with graph paper, although they were the company that printed charts, and you could buy a chart book. I'd buy one once a month and then just keep it up with a pencil and a ruler. Some of the exchanges would trade on chalkboards. They would keep price on chalkboards. If I'm on the board of trade trading Kansas City wheat, or Chicago wheat, I want to know which Kansas City wheat was trading for. I have to look at a chalkboard. Even some markets traded with a chalkboard, not a pit, like feeder cattle. And I put in an order. Sometimes it would take hours to find out a fill on an order. We would call all of our orders into the pit, and there were all kinds of little slang language they'd use. Like I'd go by 20 December, that's Christmas corn at the market, or sell copper, the red metal, at the market, just to make sure you're abundantly clear on what you were doing. And it was a fun trip. This is our house now, after a little remodeling, and of course, this was there was a great place for me to raise kids. Okay, I want to get in a little bit, touch a little bit here on how I trade. We're 10 minutes in. I'm going to just take a few minutes to talk about what I do as a trader. The last thing I'm going to do is give you nonsense information. You get together with market wizards, they'll talk about, you use VWAP, what moving average you use, what RSI link do you use. Those things are never discussed when market wizards get together with reunions. But I trade global futures markets. I trade price and price alone, classical chart patterns. I use no indicators such as RSI. I looked at COT. All the money that we trade today is money of retained profits. We don't trade other people's money. We have 3 brokerage accounts. We trade with ADM, we trade with Schwab, and we trade with IBKR. And we keep just a bare minimum at each, because we've been involved in 4 brokerage firms that went broke, costing us money. And so we do not want excess money sitting with brokerage firms. Rather, we look weekly at what we need in terms of margin, and we sweep the rest. Although in the case of ADM and IBKR, I can purchase treasury bills that are in my name, not street name, which protects a little bit more there. And ADM actually uses T-bills to meet margin, which is a nice thing for me. I want to talk to you about the process we trade. We'll walk you through a week. The big day of our week is Thursday evening to Friday. From Thursday evening to Friday, I scroll through about 200 charts, weekly charts. In some cases, there's multiple charts of the same market where I will look at soybeans. I'll look at 2 or 3 of the continuation charts. I'll look at old crop. I'll look at new crop. I'll look at GAN charts. And we look at all kinds of other things that may give us some sort of feel for what's going on. Want to know what's happening with barge rates in the river if I'm trading corn. I want to know what container ship rates are doing, ocean vessels. But we don't spend a lot of time. When I do my scroll, I probably allow about 1 to 2 seconds per chart. And, I've been charting long enough. I know exactly what I want in a trade, that I can tell by a chart in 1 or 2 seconds whether there's a trade there for me. Now, obviously, I'm looking at charts for which I already have positions, and so that's key. And so this is my Friday. Now, by the way, we have something which we call the Friday clothing cost rule here at Factor Company. We trade the Factor account. We dump all losing trades on a Friday. Our rule is do not take losers on a Friday. So if we put in a trade during the previous week, for instance, the previous Monday, and we're coming into Friday in the close, and that trade does not have a profit, that trade is gone. The Sunday is our day for entering orders. From the crawl through all of the charts, I probably picked out 20 charts that then I look at on Sunday. And I'll go back and look at the weekly charts again. I'll look at the Sunday, I'll look at the daily charts, several. And that's generally, I'm carrying 8 positions, 6 to 8 positions. I carried 10 trades into Monday, which for me is probably the largest number of trades that I've carried in some time. And so that's what I'm looking at, is I'm looking at all of the charts for which we have positions. I'm looking for a few other charts that might be candidate trades during the week. And we enter good till canceled open orders on our protective stops and on our targets. And so I could hypothetically close down my computer into Sunday evening, and similar to what Darvis did, go on a boat and check in later in the week. And so I am covered. I do not need to turn on my computer and see where markets are. As a matter of fact, I have found for me, I do not want to watch markets during the week. I do not want to monitor markets during the week. The reason is it pulls my emotions in. I can enter orders on the Sunday unemotionally. I'm detached from the markets. I'm looking at price only. Where you start to look at markets during the week, it forces you to second guess. And so I don't want to do that. Although we do take a look at our orders against the charts we have each day at about between 3 and 3:30 Arizona time, which right now is Pacific time. And we'll look at those and say, is there an opportunity for us to tighten our stop? That's really the question we're mostly asking, is how do we tighten stops? How do we really reduce the liability of being wrong on some trade? Then Monday through Friday is pretty easy for us. We really don't do anything. Again, we're looking at data at the end of the trading day. Do we have an opportunity? And I would say, generally speaking, there might be one at the outside, 2 new markets that we bring into play during the week. And those would include the markets who had on our list the previous Sunday for which we had orders. There may be another market that catches our eyes because of something big that happens where all of a sudden we say we now have a setup. I got a beautiful career. I pinch myself sometimes when I go, my goodness, I made my living trading markets. How crazy is that? I never set out to think that. I would have never guessed that here I'm 51 years old in the market. I've traded in 6 different decades successfully, and we have traded successfully as a firm. When I was included for a Market Wizards book, and I don't know how Jack does it anymore, but we have to produce very, very documented records on our trading performance. For Jack, I had to provide monthly statements for all of our accounts. I had to provide IRS statements that would reconcile profits reported to the IRS against bank records. Jack did a thorough job. I don't know how he did this past book, whether he continued to look, but Jack had us figured out at an average annual rate of return of about 51%. Our last losing year was 2013. Since then, our company account has been averaging somewhere, I'd say 45% rate of return, plus or minus 10 to 15 is really where we come in. Although, and I'll talk about it in a minute, rate of return and win rate are not metrics that we really even watch. We think they're pretty relatively unimportant. I want to talk about the odds here of trading. There is a lot of really, really good research on the success of people who have come into the business and say, yeah, I want to be a trader. That's what I want to do for my living, is I'd like to be a trader. How cool would that be for me to be a trader? And so they come in, and maybe some of you are among this group. But let me tell you, if you look through all of the research, and we have done that, and then we have posed to AI, what is the chance for somebody who had no experience in the markets, then they have 3 years of training, and then in the next 5 years, they average a performance of 30% annual return with only one losing year. What the data says is there's only going to be 2 to 3 people per 1,000 that are going to achieve that performance. And, that's what we're up against. And I don't want to discourage anyone, because there is a way through the maze. There are ways to trade it. But I think that the big thing that you have to remember is that if you lose your money, you're out of the game. This is a game not about being right on the next trade. This is a game about using risk management over 200-300 trades and then being able to get the data to show that you have an edge. Quite frankly, if young people ask me what they have a good job, they're earning good money, and they say, should I be trading? My advice to them is save as much as you can every week, every month. Save as much as you can and put money into SPY. And if you're 25 years old and you have a good job and a good career and you put $500 into SPY, every month, by the time you're 64, you'll have about $5 million. I think the odds of that are good. The odds of making it as a trader is slim. But if you look at the U.S. stock market, anybody who has been accumulating stock throughout their life is money ahead. And that frankly, is my advice. I don't advise people to get into trading, but I don't want to discourage you either. I think the key is survive for 5 years and there's hope. Keep your money together. It takes a while to figure out how to trade. I asked Jack, of all of the people you've interviewed from Market Wizards, and I think it's somewhere in the area of 90, 91 traders, how many of it hit the road? They were profitable in year 1, they were profitable in year 2, and they made it, and they made it big. And you've read about those in Market Wizard. There are people who have done that. And Jack said there might be only 3 or 4, maybe 5 people who hit the ground of all the Market Wizards, and they made it. And they made it by being right away. But the vast majority, 95%, are people that have been like me. It takes 3 to 5 years even to get a scent on what you want to do. And then it takes the rest of your life to kind of perfect it. The single biggest advice that was ever given me, and you've all heard it, and it sounds simple. It sounds so simple, not even use it. And that's what the old guys at the Board of Trade would say. You cut your losses short. Get out of your losses really, really quickly. A loss is not a testimony to your character. You get out of losses and have some provision that allows a winning trade to keep running. It's that combination which, in the end, no matter how you trade, that is what it is. Setups are not that important, quite frankly. What you do to get into a market is far less important than the orders that you use to get out of a market. Market exits will determine you as a trader, not market entrances. A setup is nothing more than a pair of ice skates and you don't know how to skate. It's a tool. It's a set of golf clubs from which you learn how to golf. Got to know thyself. The one big thing you'll find is that you are going to be your worst enemy. It's our emotions attempt to sabotage us at every turn. It's the reason that I know that I can be a compulsive trader. I know I can be sucked into FOMO. And it's the reason that I have created rules and have learned to follow those rules over a period of time that keeps my emotions away from intraday price behavior. And so you need to find your own approach trading. And it's just a matter of math. You will find that trading is the most magnificent experiment in math and statistical probabilities in the world. I really started getting into the math of trading in 2014, and I've just become captivated by the law of random probability. I'm going to talk real briefly, then I'm going to turn it over for questions about the Pareto rule, 80-20. Every trader who is a successful professional trader I know, and I know a lot from Board of Trade days, from Market Wizard reunions, is what percent of the trades in your entire career have accounted for at least 80% of your net profits as a trader. The answer every time is 20% or less. This is important because this will apply to you. Over a period of time, 80% of your trades will basically scratch each other out. 20% of the trades will give you the profit you need to be net profitable. The key then is not to have the 80% eat into the 20%, because in my case, of the 80%, there are a percentage that are small winners, but then I have all the losers that I have to deal with. And the key is to keep the losses that are among the 80% small enough so that the smaller profits that also sit in the 80% can actually let the 20% be your net profit and not be eroded by larger losses. So that's it. I'll turn it over.
Awesome. Well, Peter, thank you so much for running through all that. I also want to mention we've done multiple interviews in the past. So after this one, definitely recommend checking out the description. We'll have the links to those to go into even more detail into different concepts. But Peter, first and foremost, I want to touch on that surviving the first 5 years aspect, because a lot of traders might be in that boat right now. Maybe they've had a little bit of success right now. What are some of the challenges and obstacles that a lot of traders run into in those 5 years that they have to survive? And what are the things they can do to give themselves the best chance to make it through?
Yeah, that's such a great question. Thank you, Brad. Can I just click off of this and be back on the screen with you? Is that what we want to do? Okay,
absolutely.
Super. The first thing is expectations. You see people coming in, I had a 2X trade. I made 1,700% on this stock. You see Twitter's filled with that bullshit. And I don't like using the second word in that series, but that's the reality. You got to keep your expectations in check. Trading is a marathon. It's not a sprint. Sure, there are those people, those like market wizards, that hit the ground and they're successful from the get-go. You got to understand, those people are 5 standard deviation successes. There are those people, and we've seen a couple in the last Market Wizards book that, ran 10,000 and 10 million. That is a 6 standard deviation expectation. When we're talking about even 30% average for 5 years, we're getting down into 3 standard deviation expectations. And so this idea that you're going to come in and just kill it, it leads to bad judgment. And one of the bad judgments it leads to is too much sizing, where people come in. Now, when I started trading, I consider myself lucky, Richard, that I escaped. Because I used the trading, the sizing that I used on a couple trades were just insane. Where early on, my goal was to build. My goal was to build my account. I kept all the money in my account. My net worth was in my account. And, I wanted to grow that and grow that. I knew what size I wanted to grow it to. I mean, initially, I started in 81 with $88,000. I wanted to grow to $1 million. That was like my next point, right? I want to be at $1 million in my account. But I was willing to take a little bit of risk. Now, when I say risk, I'm saying risking 10% of my capital on a trade. That's insane. That's absolutely insane. And I could show your audience, if they're new, depending on their metrics, I'll show how they're going to eventually wipe out. That's the reality. Currently, I risk about 70 basis points on a trade. That's 0.7%. So for each $1 million block of AUM, we're worth $7,000 on the trade. What does that look like? Okay, with $1 million, we may trade 3 micro NASDAQs. And so that should give your viewers what reasonable size would be. Three of the micro NASDAQs is what we would trade for each $1 million in their account, because we keep our risk under 100 basis points. So you've got to keep your risk under 100 basis points, and you've got to accept the fact that it is going to take 3 to 5 years for you even to get a cent, for you to understand how you trade right now may not be the way that you find you will trade in the future. how you trade right now, as a matter of fact, is very likely not to be the way, if you end up becoming a full-time career trader, the way that you will find that is. And that's only by working through problems. You know, you got to be a problem solver because you got to find, oh my goodness, how do I set stops? How do I determine where I get in? How do I keep myself emotionally balanced? What do I do if I find that I'm experiencing FOMO? Do I downsize after 5 straight losses? How do I deal with sizing? How do I deal with overall risk management issues? And so I think that first 3 to 5 years, they have to just say, hey, if I can reach year 5 and still have my money intact, I will have a pretty good fix on what I want to be as a trader. But you have to allow yourself 3 to 5 years. Now, there's some people that are day trading and they say, I'm going to day trade to make money. And then once I make my money, I'm not going to be a day trader. That's the most stupid thing I've ever heard in my life. Yeah, you're going to become a day trader, what? To learn then a whole brand new way of trading? Because that whole brand new way of trading is going to take 3 to 5 years. And so I discourage day trading, quite frankly, because whereas 3 in 1,000 newbies to make it a career, that's all forms of trading. I think it's probably 1 in 1,000 as a day trader. Of course, everybody who's watching this program right now thinks that they're the 1 in 1,000, and that's the reality. And let's hope they are. So you've got to keep your money together. You've got to protect capital. Protecting capital is more important than your opinion on a market or a chart.
Yep. And I think it was telling, I forget if you said you do it daily or weekly, but a key question you guys are asking is, how can I tighten my risk on this position? How can I limit my risk as it goes? And that's like a question you ask yourself regularly. And one thing, Peter, I went back and rewatched some of the previous talks we've had, and a concept stood out to me, which was composite risk. So you as a futures trader, you're trading all these different markets. A lot of our audience is trading stocks first and foremost, but a lot of very highly correlated stocks. So, you talk about risking, 0.7%, 70 basis points on a single trade. But for us, we also think about everything is correlated in the market. When semiconductors get hit, if you have 3 semiconductors on, that risk adds up each one. So we have to be very aware of that. And when things fall, they fall all together. So I'd love to hear you elaborate a little bit more on composite risk and how you kind of handle it, or advice you might have for traders in my situation where a lot of what we're trading is very correlated.
Yeah, I don't think I would have been successful trading stocks, Richard. And I'm just being dead honest with you. I look at the stock market. That's what I think is risky. I mean, the stock market's way too risky for me because of that. I mean, the only way you're going to make real money in the stock market, I mean, meaningful rates of return. I'm talking about Stan Druckenmiller rates of return, is to be 2x on your capital. You got to be leveraged. You got to have a margin account, maximum margin. You've got to be pretty much all in. And, I refer to the stock market as, when the cops raid the whorehouse, they arrest everybody, including the piano player. When the stock market, something happens, everything goes down. There's very few survive. And so you've got your entire position in something that's relatively correlated. I am aware of correlated risk. For instance, right now, I have a bunch of international stock index positions. I'm long index in Italy. I'm long the IBEX. I was long the Topex in Japan. But futures markets for me are ideally balanced. They're ideally designed where I can have a very diversified risk. I can be long a soft and short a stock index and long a metal and spread in grains, and I can have a sugar position on, and that would be in London. And so, I don't know what I do. I mean, I really do. The idea of being in the stock market with 100% of my money, that's frightening. And so I think it's there where you really need to make sure that you have stops in place and that you are moving stops regularly. We're wrong on average 45% of the time. So 45 out of 100 trades we're wrong. We start off with the risk of somewhere between 35 and 40 basis points on those trades. Our average loss is down in the area of 15 to 17 basis points because that just reflects our ability to keep choking off risk, to bring ourselves to a break even, which we like to do within a week. We like to be break even within a week or close to it. But yeah, multiple stocks, I think people have to be super careful of composite risk.
Yeah, excellent. And one question I actually wanted to switch gears a little bit. I know you actually stepped away from trading for about a decade. I'd love to hear about what kind of contributed to that burnout and why you decided to step away. And then also how your approach changed when you came back so you could do it more sustainably. Because I think there's a lot of lessons there about longevity, because we all want to be doing this for decades. That's where the real money is made. So I'd love to hear your thoughts on that. That'd be great.
Yeah. And so it was a thrill ride. I mean, it was a roller coaster. I had multiple, the way we kept track back then of drawdowns, it was monthly. It was a monthly drawdown, month-to-month drawdown. That's typical for the commodity trading advisory industry. They report their drawdowns based on the end of the month. And that reflects closed trades plus change in open trade equity. And, so I would have multiple 40%, 35% drawdowns based on that formula. But when I looked intraday, day to day with open, I'd multiple 50, 60% drawdowns.
Wow.
That's just brutal. I couldn't do it now at my age. Younger, I could, because younger guys think they can conquer the world.
Yeah.
But, it came a point in the 90s where all of a sudden I've been doing this for 20 years and I just really was burnt out. I didn't need the money at that point. I had done well enough that I could seriously consider retiring. So I took 10 years out and started nonprofit organizations. I actually became a member, an NGO at the United Nations Council for Economic and Social Development. And, if I would fund good ideas, I really got into philanthropy is what it was. But then I started getting the itch again to trade in 2005, 2006. And, it's like, the cost of living's going up. Maybe I need to go back and make a little more. So I went back and started trading. And I was not sure whether what I did prior would even work anymore. Right. I mean, I'm just guessing I could still do the same things, use the same rules, and I would make money. But I didn't know that. The markets had gone to electronic trading. Prior to that, I phoned my orders in. I'd wait for fills. I'd talk to a human being on every order. We're entering orders on a computer, and Globex is active, and markets are being traded by computer, and they're expanded days. And it so happened that what I did worked. 2007 was okay. 2008, I had 100% year, which, by the way, is my last triple-digit year. I've not had a triple-digit year since. And I think because I've become much more risk conscious. I think my goal, and it was really coming out of a losing year, 2013, and there were reasons for it other than charting. I had the longest peak to valley to new peak drawdown in my life at 17 months. And I had the worst trading year of my life at minus 13.x. And I really decided at that point, I'm going to go down the tunnels of statistics. I need to understand trading from a mathematical point of view. Right. You need to understand how performance numbers come together, because it's not from whether I'm going to be right or wrong at the next trade. It's going to happen over 200 trades, 300 trades, 400 trades. I want to ignore each trade. I want to build data and see what I can learn. And I joined forces at the time with what was the largest computerized trading program in the world. They're located out of Chicago. I'm not going to mention the name, you'd know it. And they helped me develop an Excel spreadsheet that has over 1 million cells with formula in it, in which I can run all kinds of what-if scenarios in trading. what if I moved my stop to break even after 2 days? What if I took a loss in every trade I made? What if I changed the way I get out of winning trades and so forth? And it really helped me to get a grasp. So my obsession since 2014 has been, I don't really care what rate of return I want. I ignore that. That's just a resultant number. That is not a number that you can actually have as a goal. You have to have numbers as a goal dealing with profit factor, expected value, kurtosis, and so forth. You need to dig deep on the trading metrics. The best book, by the way, is Jack Schweiger's book, Sense and Common Sense, where he goes into every metric you can possibly use. So we become metric driven as a trading firm. We've got 4 people in the firm, and everybody is data driven. We are data driven, and we focus more on risk management than necessarily trade identification. When we think in terms of our edge does not come from trade identification. In fact, I think charts provide very little edge, although everyone needs a way to pick a trade. Ours happens to be charts, because what happens after you put on a trade, it's that data that produces the ability to say that we can have consistent records. For now, we've come to the point, Richard, where now a big drawdown for us is 4%. As we want to keep our worst drawdown during the course of the year to no more than 3%, 3 to 4%. And so that's our focus. Our focus is risk management, sizing, and how to take profits. And then we just let rate of return becomes a resultant. It's not something we're conscious of anymore.
So the result of that research that you did was to was it cut size overall, cut how much you're risking per trade because of sequence of returns and all these different scenarios? What were kind of the key takeaways from all that research that maybe people watching this could apply as well to their own trading?
Well, what we discovered, and it goes back to Pareto, is we were able to go back into past years, and I have the data of every trade I've made by trade, by size, by dates, going back to 2014. Prior to that, we had to go back and we had to look through our monthly statements and pick out good trades. But we would pick out, let's say, we knew what we made from 1981 through 2014. And so it was a question of saying, let's go in and try to find out our P&S's trades that give us 80% of that figure.
Right.
And we did that. And then we did standard sampling of those trades, really asking the question, was there anything different about those trades? Was there anything unique about those trades that didn't exist in other trades? And there was, in fact, is those were trades that tended to go not just the day we put them on, but the hour we put them on.
Wow.
They were trades that we got in and never looked back. Some trades would have little resets. They'd have 2 to 3 days of drifting sideways, maybe a week. They'd go up a little bit, and after 2 weeks, they'd come back down and test our entry point. But even that was rare. They generally were trades that we define as type 1 breakouts. That is a trade that breaks out, and the close on the day it breaks out is pretty much the lowest close from there on forward. And you can go through and find on any chart you want to look at. If you're a chartist, go and take a look at NASDAQ, take a look at S&Ps, take a look at sugar, gold, whatever, and try to find some classical chart patterns. And you will see that the trades that really put in the money were trades that broke out of classical chart patterns and just never looked back. And that's really what we want to try to do, is we're committed to try to find and be involved with what ends up at the end of the year to be the best 2 or 3 chart patterns for every market that we trade. And we actively trade 48. And, and that's all over. We'll trade wheat in Paris and wheat in Chicago and iron ore in Singapore and so forth. And so those are our candidate markets. So we're very conscious of the fact that we want a process that is duplicated. We want to know that the trade we put on in sugar this year we would put on 5 years from now if the same setup occurred in gold, let's say.
Right.
Is we want to become super process oriented, super metrics oriented.
Yeah, excellent. And have you found that certain classical patterns produce the greatest potential, not necessarily win rate, by no means win rate, but potential of the trade? So do you have some that you favor because when they come around, those are the ones that are more likely to have those breakouts or patterns that follow through, right? That's what we want, immediate follow through that just get away from our entry point as quickly as possible.
Yeah, I mean, there are patterns that we're biased toward, by all means. Well, I'll just point out the patterns that we ignore and actually are repelled by. And that's patterns with the diagonal boundary line. We do not believe, for our trading in channels, we do not believe in trend lines. We do not believe in symmetrical triangles unless they're perfectly formed. So we are geared toward primarily continuation patterns that last somewhere longer than 8 weeks, shorter than 26 weeks. We want to see congestion areas that have horizontal boundaries.
Yep.
And we would like to find that those horizontal boundaries from top to bottom represent less than 20% of the asset's value. So, if we're dealing with a stock, and I'll just point out a stock price just for example, and it's a stock that's consolidating at 100. We really don't want a stock that's developed a chart pattern ranging from 50 to 100. That for us automatically eliminates the pattern from our candidacy. So we'd like to see these tight patterns, even less than 10% from high to low is super pattern lasts 18 weeks, and then bang, you have a breakout of a horizontal boundary. Let's say it's an ascending triangle or a rectangle, or continuation head and shoulders. We love continuation head and shoulders. We love head and shoulders failures. And so all of a sudden you break out with a wide-bodied bar.
Right.
And you break up by the margin that we looked at. We use a standard percentage of ATR to determine. After we do that, we do not use ATR trailing stops, but we do use ATR to determine what point we will get into a trade. We do not want to have a stop just a tick or two above an old high. We want to see a market actually clear price highs by a large enough margin that we have a comfort level to say that this is a breakout. And, we just know that, only 1 out of every 7 or 8 trades are really going to be a trade that at the end of the trade, we say, hey, we liked it.
Yeah.
This is what we wanted. But, we have to go through 7 out of 8 trades that aren't there, Richard.
Yep.
And that's the frustration that a lot of new traders have is it's the 7 out of 8. They get down on themselves. And, based on random probability theory, you can have 7 out of 8 trades not give you what you want. And then you have maybe 1 trade that gives you what you want. And then you go back into 7 trades that didn't. A lot of weird things when you put large numbers into Monte Carlo simulators, a lot of really weird things can happen that you don't expect to happen, especially if you go into, 2 standard deviation events. And so, that's what we look for. A trade is nothing but a data point and a series of data points subject to random probability. So we don't want to get tied up in a trade. We don't want to get long gold and then have a narrative dealing with the government debt and fiat currencies. We want to be in a trade based on price action, based on price discovery, stay in the trade based on price discovery. I do not watch news. I do not read newspapers. I do not go to any website such as New York Times or whatever to find out what's going on. As a matter of fact, my son called me the day that the space people came back from Mars to ask me if I was watching the touchdown, and my comment was, the touchdown of what? because I wasn't aware that we sent people back to Mars, because I just don't follow. I don't want to be biased by news. I want to be able to look at a chart and not have some narrative. But let me speak to narrative, for instance, because
Sure.
I do have narratives. I'm a Bayesian. As a Bayesian, what I want for any given market at any given time is both a super bearish and a super bullish narrative that I carry in my head. It could be based on charts. It could be based on what I might think is going on in a larger global macro world. But I want the flexibility. I don't want to become bought into a narrative. One of the worst things that can happen to a trader is they get locked into a narrative, because it keeps them on the wrong side of a market for a long period of time where they still think the narrative is going to work. So I don't want to have a narrative. I don't want to really have a bias on a market. I want to deal in positions, and if I have a strong opinion, I want it weakly held.
Perfect. And I want to touch on something you mentioned a little bit ago about how actually failed setups, failed patterns can make the best setups. I think you said a failed head and shoulder. Why do you think that is? And maybe share a little bit more about, what you look for in a failed chart pattern that turns it into a great setup.
Well, I mean, a failed pattern is, keep in mind that these patterns, you can do computer programs where they just select numbers and they spit out numbers and they form chart patterns. And you can look at enough chart patterns that have been randomly formed by numbers, and you'll see every pattern that I trade, that they'll form. And so the reality is that you cannot look at a chart and say this is going to predict price. But you look at a chart not in terms of certainties, not in terms of probabilities, even though we keep probability numbers, but in terms of possibilities. That here is a pattern that is a possibility. This could be a possibility, a possible ascending triangle, or a possible head and shoulders. And so you go into it on that basis. Now, what happens sometimes is when they become a real pattern, there's engineering that takes place by the whales. And so the whales may see a head and shoulders top on a pattern, and actually the whales are bullishly biased. And so they will just instinctively, each of them operating, they might not know each other. There may be whales from different parts of the world. They're not in communication, but they think alike because they have discovered really what's driving the market. So it's really driving the market they've figured out. It's a rare group. It kind of brings you back to Michael Lewis's book about the mortgage crash, where you had a group of 4 people that actually figured out why markets are going to do what they're going to do. And so what they'll do is they'll let a head and shoulders top fail. It'll get a breakout. It'll get everybody sucked in. It'll get everybody negative. Then it becomes a bear trap, and the door gets slammed. And all of a sudden, they will create situations on a chart which tend to lead retail traders to the wrong conclusion. And now that doesn't mean that there may not be situations where retail traders plus whales are both on the right side of the market. But, it's something that I look at in terms of, I'm not interested in sentiment numbers. I am interested in COT numbers, where, for instance, you had at the top of the gold market that the small spec had never been larger gold futures. There were major longs in gold futures. They were the big long in gold futures. That's not a recipe for continuation of a bull market. And so, and there are cases where even the commercials, and I tend to want to trade in the direction of commercials. There are times when commercials are on the wrong side of the market, and they end up feeding the market. That often happens in gold, for instance, where commercials are on the wrong side of the market. But generally speaking, so, I'm looking at COT when I see these patterns to get a feel for, what people are thinking. I don't like patterns, for instance, that break out on news. And so we tend to say, wow, we see a pattern in the treasuries, and all of a sudden it's Fed day, and the Fed announcement comes out, and one of the treasury, something in the yield curve breaks out of a pattern. We tend to go, no, we're not going with that one. We'll let the market trade normally for 2 to 3 days and see what happens. And so, we try to combine some of these other things in terms of who is doing what and why, and what does that mean to us, and should we really take it seriously? And those are the kind of things we really like to know. Hey, we are in a possible type 1 breakout, because that gives us really control of what we feel where a market's going to go.
Perfect. And I want to shift gears a little bit to more position management, because obviously entries and setups, they can give you asymmetric possibilities, right? But it's what you do after the entry that really determines how effective that trade is going to be. So maybe walk us through high level, how should traders be thinking about position management regarding, riding that trend for as long as it's relevant for their style?
Direction does come from weekly charts. And so most normally we're saying, here's the weekly setup. Here's where we think the market could go if it breaks out. But at that point, we don't have risk reward yet. We won't have risk reward till we're in the trade. And so every day we may be adjusting our size because we're anticipating when we put that order in or change that order that night to, let's say, buy stop 20 sugar, let's say, at a certain price. At the same time, we put in an attached contingency order so that when that buy stop is executed, our sell stop automatically goes in. Most brokers offer the ability to use these contingency orders. With IBKR, it's called a what-if order. It's what if the buy stop gets filled. Now you can put in a sell stop that doesn't become active until the buy stop is hit. And so, but what happens is as the market drifts toward a breakout, sometimes you will find that you form a little pattern that becomes a launching pattern toward the tail end of a larger pattern.
Right.
That's where you get a real risk-reward asymmetry, is because, in effect, you can do the sizing of that smaller pattern while you're trading the profit potential of the larger pattern. And so it may be for us that we get to double the size of that trade that is not there. And so that's a unique opportunity. Now, what we do, and I've heard arguments by everybody for doing it, not doing it. We take money off the table. Once we go in, we do not pyramid, Richard. We are not pyramiders. We do not believe in pyramiding. When we go in with our largest position at that point. We'll never have a larger position than when we first enter a market. And if we get a market up to somewhere around 70% of what we think is the target, especially if we've had a type 2 retest, we will book some money. We'll take profits off the table, sometimes on as much as half of our size. I've heard people say, well, what if this is one of this run? It's just all of our numbers that we rely on to tell us that we have an edge are based on that approach. And it's impossible to go through every little component of our trading and optimize rules. You cannot optimize rules. The rules cannot be optimized. Moving average cannot be optimized. RSI cannot be optimized because you're going to optimize this year and next year is going to be different. Right. And so we just believe that it gives us greater holding power on the other half, that if we can take profits on half of our trade and book it, then we can say on the other half, now this gives us an ability to, let's say, ride a trade using a moving average. And in that case, we'll use an 8-day moving average. We will ride then half of the half for an 8-day moving average, and maybe then the other half of the half to see if a market can really extend. And so it's just, we're a believer in taking profits. We're a believer in trying to wait for profits, but we're a believer in taking profits. So that's kind of our strategy on that.
And is it a close below the 8-day or the relevant moving average? Is that where you're waiting for to exit the position?
Yeah, we'd like to see a full bar below the 8 and then follow through from that day. That's the full bar below the 8.
Nice.
Just simply a close below the 8. Preferably we'd like to see the 8 roll over, especially if it can roll over in a congestion area that really hasn't done any damage to the chart, but you end up getting a 4 or 5 day congestion area. It's what we had, for instance, in the IBEX, in the Euro Stocks Bank Index, we drifted sideways. And so you drift sideways, and then for sure, if you roll down through the 8, we're going to want to get out of half. If that happens before we reach 70% profits, then we make a decision. Are we going to book half for less than we really wanted to, just to put money in the bank, or are we going to keep that half? And that sometimes becomes a discretionary decision.
In addition to those rules about breaking MAs and achieving targets, do you have any time-based rules for profit taking, or maybe like your initial entry, if it doesn't push by X amount, over the next week, do you have your initial position? Because like you said, the best trades just go. So that's a little bit of an expectation breaker when it doesn't go right away. Just to hear your thoughts on that. Yeah.
Yeah. I mean, I could get into percentages, some percentages. For instance, that the chances of a certain pattern, I'll say a symmetrical triangle. The chances of a symmetrical triangle when it doesn't go and it stalls, and then a week or two later it comes back and it retests the upper boundary of a symmetrical triangle line percent. There's only a 13% chance that market will go to the 70% of the profit target. So why deal with it? They're frustrating. Those trades are frustrating. They wear you down.
Yep. They
affect your disposition. Where my attitude is, if I know that this is a trade that's not going to have a high probability of becoming one of my Pareto trades, why in the heck am I holding it?
Right.
And so at least move stops to break even. And if the market takes me out, it takes me out. But time-wise, we think in terms of price, not so much time. I mean, on average, we're out of a losing trade within a week. Our profitable trades might last a week if a market just breaks out and it just goes and just it's a lightning trade. As a matter of fact, some of your stock guys may be aware, but our single most profitable trade this year for the company was in the stock, and the stock was ARM. Where the trade that broke out, we got a position on it, went into it was a type 1 breakout, didn't retest, then it formed a slight sideways congestion, nice little rectangle or Darvas box, broke out again, and within 2-3 days, it's trading at a 2x target. So you have those, but in some winning trades, particularly like maybe in treasuries, we may have a trade that lasts 2-3 months. 3 months is usually average trade. I'd say profitable trade we hold for 2 weeks.
Was that ARM trade in May of this year? Is that the time frame you were looking at?
Yeah, we entered ARM on April 22nd.
April 22nd. Yep.
Yeah, and we added to ARM on May 20th.
Nice. So you bought the initial breakout to all-time high, it pushed up, consolidated, set up another base, and then broke out again. Yeah, that's been a great mover this year. Perfect.
I mean, we're out. Yeah. We didn't stay. We pretty much got out before it topped. We sold on the way up.
Yep.
Because we'll take profits on a 2x target.
Yep.
A 2x target happens in 4 or 5 days. I'm not going to sit around and say, well, I think we're going to hold it forever.
Yep.
It's thank you, ma'am, we're gone.
Yep. Excellent. And I wanted to hear your perspective. Thinking about position management, what do you think are some of the top mistakes or misunderstandings newer traders make about position management and how you can get the best result out of a trade that you put on?
The error that I see my community, and I have a little community of traders I share stuff with, is they'll buy a breakout, or worse than that, they anticipate a breakout. Mm-hmm. They see a pattern and they think, okay, this is going up. And they get in, and usually they get in on strength within a trading range. Buying a 2-3 day rally within a trading range that hasn't broke out yet, what often happens to that is they get stopped out, then they try it again, then they try it again. By the time the real breakout comes, they're worn out and they miss it. And so if you're gonna trade a trading range, by the bottom of it, if you're so inclined that you like buying weakness, buy the bottom of a trading range. Then you can always buy the breakout too. But it's doing that. Or they buy the breakout and then they get a profit of a day or two and they think, oh my goodness, I don't want to lose this profit. I've just been wrong 8 straight times. So that they immediately move their stop to break even, which by the way is a price above the boundary line. So it doesn't even allow for a retest. And they get stopped out. Then the market fiddles for a couple of days and then it makes a new high. They buy another new high. They realize, oh my goodness, I really lost money and now I got a little profit. Now I got to protect that. And, and so they become a bull in a market that does nothing go up. And they end up and they look back at the end of the trade and go, how did that happen? I lost money. They lose money being right in a bull market because they mismanage their positions, or they pyramid. Pyramiding is a terrible idea, in my opinion, because on the long side, it increases the average price of your entry. And it makes you more vulnerable to setbacks. And so, there are some people who do buy setbacks, and that's their approach, and it works for them. It's the approach that they own, becomes their approach. It becomes who they are. And I think that's the important thing is a trader has to figure out who they are as a trader. What rules as a trader really represents how they think and how they work and how their mind works. That's why it takes that 5 years to get there. So that's the mistake they make, or they get out after it runs. They get a good week on it. They get out. Then they wait a day or two and it keeps going and they jump back in. Then they get it stopped out of that. And so they don't really take advantage of the magnitude of a move in which they were right in anticipating. Or they get stubborn. They get a narrative, oh my goodness, I gotta, the only way to be in gold is long. I gotta be long. And so they get that bias or they overtrade. Most people overtrade. I every once in a while, I'll put out on general Twitter, what's the maximum amount of your capital that you risk on a trade? The answers that come back are insane. A lot of them are coming back and saying, 0.2%, 1/3%. But you got a lot of people coming out going 5%, 10%, 15%. They're destined for a blowout. The idea is if you have a 3 in 1,000 chances of making it as a trader, what you got to do is you have to rearrange the odds. You have to say, how do I convert those odds from 3 to 1,000 to 10 to 1,000? Then how do I convert them to 20 to 1,000? How do I get to 100 and 1,000? And you do that by staying alive. You figure out things by staying alive that you need to do. I can't emphasize the importance enough that you learn to be a loser. The first 3 to 5 years should be learn you become a really good loser.
Yep.
Not a big loser, but a really good little loser.
Yep.
Because then you can be in a position to all of a sudden really stack the odds in your favor. Is if you avoid those big mistakes. And I would just say, learn the data. Become really familiar with metrics. You look at businesses. Somebody owns a McDonald's franchise, somebody that owns a franchise for this or that or another thing. They've got business performance data all over the map. They keep track of their business. Yet people come in and they put 20% of their net worth into an account and they don't keep track of their results. And, I asked somebody, what's your profit factor? What's that? what's your Sortino? Well, I know my Sharp. Well, big deal. Sharp and win rate are useless. Actually, they're negative. They're worthless. They're not just good, they're worthless. But they know they're Sharp, but they don't know their profit factor. They don't know their Kelmar. They don't know their expected value. Yeah, and it's only by trading the exact same way for at least a year, preferably 2 years, where you can get 100, 200, 300 data points, where now you can put it into a Monte Carlo simulator and find out the kind of range of performance NAV graphs that you might get. And you get an idea of where you are, and then you develop the confidence in your metrics. You don't develop confidence in the way you trade. You develop confidence in the metrics that are produced by the way you trade. And when someone asks you, well, why did you take profits at 70%? Because I don't know what my metrics would be if I didn't take profits at 70%. Why would I add a variable into something that I know are pretty fixed numbers for me? There's no sense in adding a variable. So I know that's how I feel about that.
Yeah, and to touch on what you said about the most common mistakes, a lot of them seem to have to do with random actions, making random decisions, not based on rules, but based on feelings and emotions. And that's what rules are there to help as a guide. So you become more systematic, become more uniform in your decisions. So then your data points are actually relevant, right? So that's a big step.
Richard, the trades that somehow I really feel the most comfortable with, they're easy to pull a trigger on, right? I mean, it's easy. It's all just not a problem with this trade. They generally have the worst performance. And sometimes some of those markets I really had no expectation for. ARM was an example. I had no expectations other than somebody sent me the chart and I go, golly, I need to trade this.
Yep.
Because I don't scroll stocks. I have no idea what's happening in the stock market if somebody doesn't send me a chart and I drool over it. I had no expectation. I didn't know anything about the company. I still don't know. I don't know what the company does. I know the symbol. I traded the symbol. So they surprise you. Last year, Euro stocks by the Eurex exchange in Europe. I have not ever traded Euro stocks, bank, futures, index in my life. Last year, it was a really profitable trade for us. We hit it 3 or 4 times for good profits. I'm not sure in the future I'll ever trade that futures market again. I mean, I might. I'm going to definitely keep the chart on it. But those were that was a totally unexpected gain for me last year. I would have never guessed that I'm going to make money this year. And I think the same thing with silver or gold. It'd be interesting to think I'm going to make a lot of money in silver in the next 2 years, but I don't know that. I don't know that for sure. And so, it's holding back on expectations. Hold expectations really light. Don't hold them. Don't squeeze them. Because they'll disappoint. Because when you start holding expectations, you end up with a bias in a market, and a bias in the market is the worst thing that can happen. I know for a fact that there are people that really timed the top of silver in January really, really good, but they couldn't stay away from the market. They made so much money, they just had to get back in. And so they've done nothing but try the silver market from the long side every time it's shown strength since the January top, and they've given back half their profits. Where, if they just wait for the market to tell them, they wouldn't have had a trade in silver since they got out in January. So it's not having a bias. Stay away from trying to have a bias on the market.
Yeah, excellent. And a follow-up question on keeping data, because you keep all of that data as much as you can. Have you leveraged AI to kind of get an outside perspective on your numbers, or just kind of think about things in a different way, or to kind of understand yourself as a trader a little bit more with that outside perspective? I'd be curious to hear that if you've attempted that in any way.
Oh yeah, I mean we've had AI analyze our data, and that's year by year as well as trade by trade going back to 2014, as well as monthly rates of return going back to October of 1981 when we founded the company. And the AI gives us it gives us insight. It reinforces our confidence, right? I mean.
Right.
A couple of years ago, I was wrong on 19 out of 21 trades I put on were wrong. And I know that would discourage a lot of people. And they would be saying, what do I change? I'm doing something wrong. What can I change? I need to adopt another method. I just felt like, yeah, that's whatever. I mean, it happens. And, the next 10 trades put me in a new all-time forever record highs. So we keep an NAV chart that goes back to 1981. Now, during that period, our assets were different. And so, but the only way we can really track, you can't track it based on dollars made. You have to have a better way to track that standardizes. And so we use an NAV curve. And our thought is that we never want to be more than 1 or 2 trades away from a new all-time historic company NAV high. 2 trades. Don't want to be any more than 200-300 basis points away from a new all-time high. The other thing I'm just going to mention that I think people need to know is you see people on Twitter that said made 140%, made a 7x on this trade. And if you look closely, what they're doing is they're reporting the percentage gain on an options price they paid. And that's not the way you report performance. People need to report every performance number they have against their total capital, against their total nominal capital. You don't express the results of a trade against the margin, against the cost of the stock, against the cost of the option. You measure the results of every trade against your total nominal capital. That's the correct way. And so I think if people are looking for people to follow and they see somebody reporting these 1,174% in 2 weeks numbers, they know who not to follow because there's somebody that doesn't even know how to express the results of a trade. So that's a word I would tell your folks is standardize everything. Standardize NAV, standardize how you express results, standardize your processes. My day looks exactly the like. If I am going to try to retire, I'm on the road to retirement. There actually is a retirement plan that takes me out. I won't say the date, but if I wasn't going to retire, give me a Friday date 4 years from now, and I'll tell you what I'll be doing at 2 p.m. because it's process. The edge does not come from trade entry. Trade entry does not give you an edge. Your setup does not give you an edge. You may think it does. You may be sure it does, but I'll tell you it doesn't. Your edge comes from risk management, from trade management. It comes from emotional management. A large portion comes from emotional management. That's why I tell people, don't be a day trader because it'll force your emotions to play. Become an overnight trader, turn your screens off during the day. Take your emotions out of the equation and you'll do better off. You got to manage process. You got to manage how you review and do analysis to try to discover what's happening that I actually do need to change. It comes from the whole composite of what you do. And I think it's really hard to attribute a percentage of edge, but I think the percentage is largest in a provision to let profits grow, in the process, and in how you handle emotions. That's where the largest contributions to edge comes from.
Perfect. Peter, always great talking with you. I've got 2 last questions for you. First, how much has kind of, or what kind of outside things outside of trading has helped you perform over decades. I know you're into cycling and exercise, so I'd love to hear your thoughts on like things outside of trading that we can do to set us up for success. Again, not just for 1 year, but over an extended period over decades. I think that'd be great to hear.
Yeah, I mean, one of the big things, Richard, is what's your motivation to trade? Mine was just to have a job. I want to be as excellent as I can in every aspect of my job. Is seeking excellence. I seek excellence, not performance. I want to measure myself by what I think excellent is in what I do. I'll let the profits take care of themselves. I do not live to trade. Guys that trade crypto all day long, you're up at night. They're living. Their life is about their trading. That's a really bad place to be. I want to keep trading separate from my private life. And so for me, it's my Christian faith. It's my relationship with my family. I've been married 58 years to a girl I started dating when she was 16. It's my kids. It's my grandparents. Now, last summer I lost the ability to walk, and so my physical ability has been greatly impaired in the last year. But I still do swim. I swim a third to a half a mile, 3-4 days a week. I do stretching at stretching class because it helps my mobility. I'm able to get out and play 3 games of pickleball. I'm not sure that the verb play is the correct verb to use. To hobble through, I think, is probably the better. And the lovely people are patient enough that they're willing to play with me. But it's doing those things that are away from the market. I might spend in composite screen time, order entry time, research time. I may spend 5 hours a day on the markets. But I don't like spending much more than that. On Thursday and Friday when I'm just cranked down, that's just I just can't wait to be done because I go underwater and I stay underwater for basically 18 hours with 4 hours sleep in there. And but that's my work. I'm done working. I'm done working by Saturday morning for the next week. And just friends, having friends, being social with people. So I want to always keep trading lightly held. I don't attribute my success to trading to my intelligence, to my hard work. I think there's luck involved. I think that I ended up having come in to the markets in a time when there were wonderful, wonderful, wonderful mentors. I mean, Richard, the Board of Trade in 1975 had as members a number of guys that fought on Omaha Beach. They fought at Guadalcanal. These are guys that understood danger. They understood risk. They understood life, how precious life is. And they were generous. I had some mentors who were generous. I wouldn't have made it without the mentors I had. And I happened to come in at a time when markets were just fabulous. In 1982, we saw the bottom of a bond futures market. They had been in a bear market forever. We saw a bottom that still exists. Gold, we saw big bottoms, so I was lucky enough to participate in timing. My timing of entering the markets was such that I might not have made it if the timing had been different, if I hadn't discovered a chart book. And so I kind of, in some ways, feel like I was chosen. And I hate to make that sound like, I was privileged because I was chosen. But by that, I mean, it was just sovereign fate. It is sovereign fate. Had it be that Peter Brandt and who he was happened to decide he was going to trade futures. And a lot of things came together for me that I didn't engineer. They weren't of my own work. They weren't of my own thinking. But I look back and I realize how crucial certain things were that fell in the line that allowed me to be able to make my living and build my wealth by simply speculating in commodity futures market. People tell me, really, what are you doing? I basically say I gamble. I mean, I do. It's basically I'm a gamble. And part of that is there's no social benefit to that. I'm not like a doctor, not like an emergency aid worker. I'm like somebody that helps you on a help desk at Apple computer when you have problems with your Mac. They actually provide social benefit. I provide no social benefit. I'm simply liquidity in a gambling pit. And so I think for traders, they have to find something that's worthy to do. What can they do outside of trading that actually provides benefit to people? A food shelf, a shelter for the homeless, something like that, helping crippled kids at Shriners Hospital. But I think it's important for traders to find something to do because their job does not provide any social benefit. The fact that they may be providing liquidity means nothing. That's not a social benefit.
I push back on that. You provide no social benefit because your teaching has helped a lot of people, just like your mentors helped you. You're helping others through your teaching, so that's an immense social benefit. And Peter, really always a pleasure speaking with you. Do you have any last kind of words to leave everybody with today, or if a trader watching this earlier in their trading, if you want to pass on one complete message, if you want them to have one takeaway from today, what would you say to really focus on?
I would say they should not trade. Yeah, thank you for what you said about benefit to help people. The biggest pride of my career, quite frankly, there were two. One, that I was selected to be a commodity crop trader. We're dealing with Paul Tudor Jones, Bruce Kovner. That was an honor. The other honor is there are now 5 other market wizards that cite me in their interview as the source of their knowledge about risk management. That's actually the thing I take more pride in than anything else, is that out of my education has now come 5 market wizards, guys that have achieved greatness on their own. That is super cool. I would say read every Market Wizards book. Read Market Wizards books. I wouldn't buy the how-to books. Somebody's how-to books on trades. They don't mean anything. Ben Tharp has a good book on sizing that you probably should buy. But how you use a momentum oscillator, how you do that. Of all the times I've gotten together with Market Wizards, Richard, the thing I've never heard is what RSI length do you use? Do you use moving averages? Do you day trade? Those things are not discussed because those things, quite frankly, are not important.
Excellent. Well, Peter, seriously, thank you so much for taking your time to speak with us today. I'm looking forward to watching this back and taking even more notes. But Peter, thank you so much. Appreciate you sharing your wisdom. And to everybody watching, I hope you guys enjoyed as well. Leave a like down below if you did. Subscribe if you're new to the channel. Peter, thanks again, and we'll be right back. Take care, everybody.
Thanks, Richard.
All right, welcome back, everybody. It's my pleasure to introduce the next speaker of the TraderLion conference, Pradeep Bonde. He's the founder of StockBee and the mentor to Market Wizards. And today he's going to be discussing quite a few concepts, his key trade setups, and how to create a trade factory, and a lot of the nuances that I think most people don't understand about episodic pivots, momentum bursts, and his way of trading. So Pradeep, first of all, thank you so much for being a part of this. Once again, appreciate you taking the time and looking forward to this. Welcome.
Yeah, sure. Welcome. Thank you.
Yeah, let's dive in.
Yes. So let's start by looking at some of the core things which I look for, and what I am looking for when I am doing my personal trading is I have a clearly defined thing that I want to focus on magnitude moves and not duration moves. So magnitude moves are these moves which are like very, very aggressive, 80, 100%, 200%. They happen in a few days or weeks. And like these are like meteors which shine brightly for a short period of time, and then they might just kill themselves or whatever might happen. I'm not looking for duration moves of weeks and months and all, and I have nothing against people who trade that, but that's not my cup of tea, okay? The next thing which is very key to my looking at this, whatever I'm doing every day, I'm looking for situational awareness. That's like absolute must. In fact, and I have some things which somebody has made for me, and which is basically a quote on situational awareness, which says that, look, if you are hitting on girls at a funeral, do you have situational awareness? Okay, so it's like every day morning, I'm trying to answer some of these questions. Are breakouts likely to work? Are breakdowns likely to work? And that's the starting point. So if I don't know whether breakouts are going to work, then nothing is going to happen, right? And that's the thing which is. So situational awareness, extremely important. The more I trade, the more I understand that the key really is situational awareness once you are set up, because the moment you lose situational awareness, drawdowns, breakouts stop working, you get into very frustrated phase. So I only trade with situational awareness. That means there are times when I'm not going to put a trade, or I'm just going to put some few 100 shares or some position just to check the water, and I'm not going to be really excited. There are some absolutes which I have created for myself, which are always buy on a first day of a breakout and as early as possible. Because if you're going to be buying breakouts, the earlier the entry, the better it is. Because if you enter early, by the end of the day, you have a buffer. You can move your stop to break even and the trade is free. If you enter late, your stop is going to be wider. So everything, when I talk about my trade factory, is based on these principles. These are like the foundations for everything. So I really, really focus on the first half an hour or 1 hour of the market open, because if I can get in there, then it's all easy. Whenever I'm buying breakouts or anything which I'm doing, and if I'm going to buy any stock, I always look for tightness. I want to see 2 tight days or 3 tight days or 4 tight days. And that's one of the ways in which you can get closer stop, because if a stop is having a very tight action, then the explosion makes sense, buying breakout makes sense. So that's one, or a negative day. I always look for young setups and moves, which is one of the problems which I see in trading when I see outside traders and even some of the StockBee members. They're buying moves which are late. They're buying setups which are stale. They're buying setups extended. So the more you buy extended setup, it's you're going to be just not. So we actually have a saying on StockBee side, be a cougar and go for young things and not date older things, right? And basically, always look for catalyst. This is a new thing which I added more and more now. Even if I'm buying a regular breakout, I always want to find what is the catalyst. It means is there a reason why this should go up, right? There are a lot of pretty looking breakouts which happen and you buy and nothing happens because there is no reason why the stock should go up, right? And so always look for some catalyst. It may not be a major catalyst. It might be a minor catalyst. It might be a sector. It might be a theme. It might be some recent news. It might be government policy, but something has to be there for this thing to move. That's one thing which I have really added in the recent years to improve the win rate. The second thing which I added also, which is related to this, is whenever I'm buying, I'm always thinking, okay, who's the fool or the next person to whom I can sell this to, right? If I can articulate, look at there are these people who will be buying this because it is going to reach this resistance level, or they are going to buy this because they are looking at some sort of a level to buy or things like that, then I can sell to somebody, right? If I cannot articulate and figure out who's be the next set of buyers for this, then I'm the only fool who's buying, right? And this is a greater fool theory, right? We make money by selling to somebody who doesn't understand, or who buys on third day or fourth day, or who follows a newsletter, or who's believes in some buy points which are above your entry points. So that's another thing which I am always, and this is why I track some of these things on Twitter and all other traders, and I look at where are they going to buy, where are they going to get excited about, and then the game is to try and buy before them and sometimes sell it to them, or they come in and the move gets magnified. So that's another thing which I always look at. I always ask this question, okay, look, okay, if I buy this, whom am I going to sell this to, right? And then always look for opportunity to size up. And this is one of the key nowadays, which is the more funds I have to trade, it becomes more difficult to trade these small $3, $5 or some of the other moves. They are very, very attractive and they look very attractive, but I can't size up. So I exclusively focus on more fund quality stocks, and fund quality, I define it as something which is owned by 500 plus funds or 1,000 plus funds. So that way you're buying something, and there are enough opportunities in a fund quality place that I don't have to go into the lower quality. I don't mind, there is a lot of money in this lower capitalization, nano cap, micro cap and small caps, but the problem is you cannot size up, and if I cannot size up, then you cannot move larger amount of sums of money by doing those kind of trading. But yes, for somebody else who has a smaller capital base, that's a very nice opportunity. I also built my capital to where it is by doing those kind of things. But the game has changed for me. Things have changed. Life is different now. So I'm looking for fund quality thing and also sizing up. Really, this thing is, once you're on age, is how much can you size up and where are the opportunity to size up. And that's every day I look for opportunity. Where can I size up? Where can I put big position? Always develop new edges and variations. Expand your playbook. Most people outside of stock B and all, they think that I am trading EP. EP is the least important setup for me nowadays, right? And I have a variation of EP which I trade, and it gives me more opportunities than EP because I know the age on EP is less and less, and gaps are too high. So I created a variations, and there is no end to creating variations because you cannot depend on one age. Ages deteriorate, ages evolve, ages become too popular. They make entries difficult. So I have variations of EP, which is delayed reaction EP or EP 9 million or some other wages which are not yet in public domain because we don't want the ages to deteriorate. And one of the things, always study 20% and 50% moves. This is like an absolute rule as far as I'm concerned, because I make money by buying moves which will make 20 or 50% move in a short period of time. So I want to study them obsessively to see how they move and get. So every day I study 20% plus, every day I study 50 stocks which go 50% plus in a short period of time. And this I learned from my previous career where I worked for advertising for Unilever. Unilever is a market leader in the world in detergent, underarms, deodorants and all. Still today, every day, they catch hold of some 500 people and study how they how much deodorant they put in, what happened, and things. They're obsessed. And the reason Unilever tells you when you join Unilever, that the day they stop obsessing about understanding consumer, the game is over because somebody is going to outsmart them. So same way, 20%, 50%, that's like golden standard as per that. And all my learnings, all setup ideas, entries, exit, everything comes from that study. And then age, turnaround and rotation. I believe that real money is in how frequently you can turn around your age. The more frequently you can turn around your age, the more better it is, rather than looking for longer duration ages. So that's the core part of the philosophy for whatever I'm going to go through in terms of my trade factory. Okay, so using the principles which I discussed with you and those foundation ideas, or that is my really my business defined as what I'm trying to do and what are things important to me, what I operate on a daily basis is a trade factory, which is like a daily process flow which takes all things into consideration. It's a continuous loop. There are things which I do pre-market, there are things I do at the opening, there are things I do at 1:30, there are things I do at 3 o'clock, 3:30, 3:58, and so on and so forth. It's a well thought out trade factory to trade the kind of setups which I want to trade and the ideas which I want to trade. So it's a defined process and set of tools run on a continuous loop designed to consistently find trades. The goal is to remove every in the moment decision, standardize like a factory, have a process flow, have a conveyor belt of ideas coming. When the ideas come in, there is some quality control process, context, there is a set of rules or set of like criteria as a stock needs to meet, and everything is then pre-planned. There is nothing which I am doing which is like on the fly basically, right? Write trade, the tools, execute the plan, and you just follow the trade factory. Anything which is outside trade factory, I don't even care about. I don't even take a trade. So the trade factory has two conveyor belts or two sections. One is which is home runs and mini home runs. These are the setups which I trade, which can move my account in one trade to 20% or more, or sometimes like even more in terms of it can even move more than 100% in one trade. So these are different quality of ideas, or they have a magnitude which is greater than a normal kind of a magnitude which is going to be possible. So for this, like I say, I trade a set of setups and not just one setup. EP is what people know most about, but in reality, EP is least important setup for me today. EP 9 million and DEP, which is delayed reaction EP. These are the two main setups. Out of that, like really, EP 9 million produces the most returns for me, and DEP, which is a variation of EP 9 million, which produces most setups basically. And I'll go into detail as to what those setups are. But so for these, I run scans. So the scans are EP 9 million and DEP. So EP 9 million is a scan where I look for a stock which has made more than 9 million volume traded for that particular day. DEP is a scan which I run to find stocks which have done that in last 1 month, and then I look for low risk entry on them. And I'll get into details on explaining this whole thinking behind why I'm doing this, what is the logic behind this setup once I'll go through this particular slide. Now, but I'm not dependent on mini home runs and home runs only, because there is like whenever you're doing this kind of a trading, because of the kind of stocks which are on the way, the kind of moves they make, you need wider stop. You need 8, 10, 20% kind of a stop sometime in order to trade these kind of moves. So I also trade something which I call as singles or base hit, which are like pattern based. This is all catalyst based. This is pattern based. Okay. In this, I'm just looking for a trade which is like going to move my account 0.5% or 5% in one trade. So if I like say buy a breakout, and if it was like say 20% of my account and it goes up 25%, it's going to move overall capital by 5%. Or I bought a stock for 20% and it just went like a 10%, I'm going to make 2%. But I'm happy taking those trades because those singles add up. and they give me the buffer to take a trade with a size here. If I don't do single, I'll never be able to do size. So it's a combination of these two approaches, and they are same thing. Essentially, all of this is breakouts or anticipation. It's just different kind of opportunities or expansion of the edge into different kind of. It's like, and I always tell people on the side saying, look, Coke, Diet Coke, Zero Coke, Orange Coke, Lemon Coke, and if you go worldwide, there are 70 different varieties of Coke. But at the end of the day, it is just water, some flavor, some caffeine, and some coloring, right? And same way, these setup ideas are variation, but they appeal to different kind of market environment, or they give you a different kind of an opportunity to make money. So for this, I have scans like combination bullish and bearish, which I run during the morning sessions. Then I have scans for anticipation, which I run during the afternoon. And I have a reversal bullish as a setup, which is like a setup idea where I look for something which is going to be a reversal. So this is the essence of the trade factory. Trades can come from here, trade can come from here, and then I take those trades. So let's go and look at basically the idea of EP 9 million, because that's like the main thing. I'll start with EP and then I'll go into EP 9 million, because there is a lot of confusion. People don't understand, or they have their own view about this. I just want to clarify things. Okay. Any questions before I go?
No, not yet. I think this is good.
Okay. So let's go back to this, what I like to do, use here, right? And so let's like kind of create a fresh slide, and let's try and do this this way, right? And so there is EP. There is EP 9 million, and then there is delayed reaction EP, right? And basically, and then I have some other variation which I don't want to get into because the age might erode, so we don't want to talk about it. But EP is a catalyst based trade, and on a neglected stock, and by definition, it is a gap. So let me give you an example of an EP which I traded this year at the beginning of the year, and that was, let's go to this. Okay, CRCL. Okay, so here, Circle IPO'd, it went into a long period of neglect, nothing was happening, and this is the day when there was a catalyst, and from this catalyst, which was a earnings as a catalyst and all, and then the stock made a move up around 81%, and it made that move in just 15 bars, right? I didn't trade Circle itself. I used the ETF, which is CRCA, to magnify my returns on this particular trade. So CRCA, which is like so that made 70%, this made 206%. So I use, nowadays, if there is a substitute, I use that particular thing. Now, in this particular case, there was a clearly identifiable catalyst, which was earnings. Earnings was blowout. The stock met my conditions of EP, which is like it should be neglected. There should be a massive earning acceleration or some catalyst. And then the stock exploded in this particular case because I had identified EPs as a trade are identified pre-market, right? Because they are based on gap, they are based on catalyst. I knew this pre-market that this is stock is gapping up, and what is the catalyst, right? So this particular stock made a big, like because I took circa, I made like a lot more. And so here I entered early first thing in the morning as an what is called as an opening guarantee price OPG order, and then subsequently like it kept on going up kind of a thing. So this is a kind of a trade where I research a stock pre-market. I go through a certain criteria which I have, which is like it should have a massive catalyst, acceleration in sales or acceleration in earnings or some theme or something like that. But it's very clear before I enter this that this is a gap and there is a catalyst, and this is like, okay, fine. This is like something which is I can identify, the information is there to identify this particular thing, and I can enter based on that. That's EP. That's like an essay, something where there's a clearly identifiable and it's a gap. Now, EP 9 million is a very different idea. And in order to understand this, so if you have any questions on this, the way I do it is like there is this set of criteria which I have, which is Magna 53, cap 10 by 10, which is like a qualifying criteria, which I use to qualify an idea. So in the morning, if I get an idea, I look at whether it has a massive acceleration or a massive catalyst, that is MA, G, whether it is gapping up, N, whether it is neglected, and neglect can be in various forms. It can be a price neglect, it can be analyst neglect, it can be a earnings neglect, fund neglect, blah, 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 news neglect and all. And 5 is, it should have 5 days plus kind of a short interest. But this is not essential. This is good to have because it makes the move more explosive. And 3 is 3 plus analyst raising their price target. And then capitalization below 10 billion and IPO below 10. If that is there, that adds more to the explosiveness of this thing. When I go through this and I research, and nowadays research has become very easy because I use Gemini, I use Grok, or one of the AI kind of a tools. So I try and figure out for every EP which I buy, I figure out what is likely move that it is going to make. So when I looked at this, I said like based on all the information which is in front of me, this is going to make 50 to 100% more, right? And that is based on years of experience studying things like this and all, and that stock ended up making that kind of a move in pretty fast, right? And this is what is a magnitude move is all about, right? And it made that move of like 70% in just like 14-15 days. And this is what I call magnitude moves, which are like they are not designed for duration. If I kept holding this trade, I would be like not be even making money on that, right? And so this is just for magnitude. Now, so this is the thing with this kind of a catalyst based kind of a trade is the frequency with which this happens is very low. You get one trade, and after that, the next trade might come in after like 1 month, 2 months, 3 months. In a year, you're likely to find only 3 to 10 trades like this. Unfortunately, I can't run my life and my thing with 3 to 10 trades, even though they are very explosive. I made good money on this trade, really like it was a banger. Came out in the beginning of the year, first month of like it was in January or something, right? And so it just like in the beginning first quarter, so it made like a good this thing. But I cannot depend on this because the next trade comes in very infrequently. So frequency is an issue. So this is why I trade this if it happens. Like just yesterday there was another EP which happened, which was BFLY, Butterfly Network. You see. It had this catalyst, AI, mid-journey, and it like showed up, gapped up, had some sort of a thematic catalyst or risk catalyst theme AI, which is a big theme nowadays, right? So, but it doesn't happen frequently. So how do you solve that problem of frequency? So I created this setup idea called EP 9 million. And when people hear about EP 9 million, they are like, they dismiss it, and which is very good because I 100% agree with them that there is nothing in it and they should not pay attention to it, and this is just stupidity because that's exactly what it is, okay? It's very good if people don't understand ideas and they don't get excited with it because that's where the edge is, right? Basically. But here is my logic and thinking. This idea started by reverse engineering. When I looked at EPs and when I looked at 50% plus moves, there are a lot of stocks which are making this 50, 100, 200, 300% move, but you could not identify them by just EP or catalyst because this was not apparent. So, to me, EP 9 million is a scan-based setup, while EP is a news-based setup, while this is scan-based and most of the time non-gap setup. And I'll show you an example and you'll understand much better, right? Now, here is a trade which I did a couple of months ago or a couple of weeks ago, Sweet Green, right? Now, this stock on this particular day is there was no news. Even if I had seen the news, it was not gapping up. There was no reason for me to even look at it pre-market or things like that, because it wasn't even gapping up. But this stock traded around 10 million shares. That is when I started researching it, and I found out that they have a new product, new wrap, new CEO, and as a result of that, like on social media and all, people are growing crazy about this thing. So I bought it on that day based on this thing, and this thing, based on that information, I thought it will make like a 30-40% move. And the trade, it ended up making that in 7 bars. Another trade which I did, which is again an example of EP 9 million, which I would have never found using my framework of EP, was this NFS couple of weeks ago. Like again, this was gapping up like not even like 1% or 2%. So it's not even something which I even noticed in pre-market. Even though I saw some news item about NFS, it wasn't gapping up 5-10% for me to get excited. Then I saw it here in my scan. Then I started researching. They had a new product, right? I said like, okay, researched. That new product has something to do with like an AI and the data centers and things like that. So I said like, this makes sense. And now this stock went up 88% in some 10 bars. I would have never found this trade using the EP logic, but my different setup idea finds this trade, and that is exactly what. So as a result, what I would find 3 to 10 opportunities, I am able to find 300 to 500 opportunities. Most of the time, it's my limitation in terms of capital, or like how many ideas can I take in a day kind of a thing, which limits the number of ideas which I can get into. So let's see the logic of EP 9 million, which is like derived from doing some going through hundreds of examples of stock which made big moves, like this NFS kind of a thing. Currently in the US market, there are, so say how many stocks are trading in the US market? There are 6,500 stocks trading in the US market. There are 6,000 ETFs which are trading in the US market, approximately. I just rounded up, right? And there are around, say, around 400. So let's round it up to 500 ADRs which are trading in the US market. So added together, you're looking at total of around 13,000 stocks or ETFs or ADR which are trading in the market on any given day. Right? Out of these 13,000 which are trading, when I look for my scan condition, which is looking for stock which I have traded volume of more than 9 million shares, on any given day, you get only around 200 to 250, or that is like out of this 1300, 2% of the stocks, and most of the days it's not even 250, it's less than 250. So less than 2% of the stocks trade this kind of a volume. Now, okay, there are stocks which trade that kind of a volume every day, but NFS never trades that kind of, or what I am saying is that these are the stocks which for whatever reason on that day traded in terms of total volume traded, the top 2% of all the stocks trading in that particular, or ETF trading in that thing. So I want to know, if a stock is trading that much, why is it doing that? There must be some reason, I don't know, right? There must be like, there is always something there, or like there must be a thing. And then all that I do is, then I investigate, and if I find a good enough reason, I go into that particular trade. And it finds you so many trades which make 20%, 40%, 50%, sometimes 300% move, which you would never find by using this framework. So what it does is it expands your edge into like and then the theory of edge rotation and things like that comes into place. So this is able to find things which I would never find using, like I will give you another example, and I have hundreds of examples because this happens so frequently and I don't even depend on this nowadays. If it comes in, good. If it doesn't come in, I am not worried. If I don't trade a EP ever again in my life, I am perfectly okay. There is no problem. There is still so much opportunity in the market, right? On that day, a couple of weeks ago, I saw all these stocks having EP 9 million, right? And a DAL is showing up in my scan, right? And that day, all these airlines were showing up. So there was information here, right? And AL, DAL, UL, all of them are trading. They don't trade that kind of a volume, right? And then they are trading in the 2%. All that I did is like, and I bought every single airline stock which was meeting my criteria. That day I bought like AL, UL, DAL, because I just was not sure which one, Love, right? All of the Love didn't have EP 9 million. It had like almost like in 7.9 million. It missed by that. All of them. So it was very clear, and I have seen this multiple times. When a sector is about to start a move or a new theme is about to show up, it shows up with volume. And the other question one has to ask is, if something is attracting this kind of a volume, who's buying it? Because most people don't even pay attention, but this is institutional footprint, right? This was very clear on that day. Institutions were getting into these airlines. And so, like if you see JetBlue, every one of them was having this EP 9 million. And I just like, and I ran my scan, I saw them. Yeah, and all of them went on and made 20% in 3 to 5 days. And that's how this EP 9 million as an idea is. So there is a variation which I created of EP 9 million now, because a lot of time, by the time I research and identify, sometimes they have run up too much, or sometimes there is a stock which is a catalyst, but it gaps up too much. And I don't want to chase gaps. Like, and I did that early in my career when I was an idiot, or when I didn't have enough information, or I didn't understand. So I was taking gaps of 30, 40%. I don't want to chase gaps now, right? So if there is something which has a EP and it gaps up too much, I just like, and I wait for it to set up as a DEP. Here, this stock gaps up, and it gaps up like some 53%. I'm not going to chase a 53% gap. I'm done chasing that. At some stage, I used to chase these things. I waited, and then this is showing up in my scan, EP 9 million also. I know what is the catalyst. I know there is a genuine catalyst, and I waited, and I entered on this day. And then the stock still made 87%. And I would have got stopped out if I had bought on this day, right? Which is what happened to many people. Or there is another stock which is a very good trade, and I could do it with size because it was an institutional quality stock which I did, which is a DEP. Here, GLW comes out with earnings. Earnings is blowout, right? And it gaps up. And then I looked at, like, it showed up in my EP 9 million scan. I looked at the volume. Volume was one of the 2 years, 3 year high volume, and things like it's an institutional quality stock owned by thousands of mutual fund and all. So, and then it had this kind of a thing. So this is where, like, I was, so for a DEP, which is just a variation of that EP 9 million, I wait for some sort of a orderly pullback. I wait for some sort of a thing like this. So this is where I was like, and I put it in a watch list. Next day morning, when it started breaking out, I was there within like in the first 5 minutes as soon as it started breaking out, because I had done research. I knew this I'm going to buy. And I had like, and don't even ask how much size I had, because the stop was so close, right? Because you're literally like sitting there like a hawk watching this, and this is, you get it in the first 1%, 2% of a move, you just like loaded, and then the stock made a move of around 43% in 10 days or 15 days or 18 months, right? Basically. So this is the framework for EP 9 million and DEP, which is basically looking at the non-gap or the things which I could not find EP. And there are more these kind of opportunities in the market in my studies and in reality than these opportunities. So this has become my primary setup. And this is basically, DEP is just a variation of that. Or for a DEP, what I look for is something which did EP 9 million in last 1 month, and then I wait for a better entry, very low risk entry on it. Like, just to give you an example from yesterday, this Okta, which had a here, okay, this is where like yesterday is when I bought it, like because it was in my watch list. I was watching it after a pullback, and again this was like EP 9 million. So I can qualify it and do things like this, right? So that is the logic behind this particular setup idea, which is to focus on stocks which trade in the top 2% volume on that particular day and find out why, what is the reason, and especially if they're non-gap kind of a thing, and then use that information to make a trade and then go into it. So that's the thing basically, right? And so even though people say, oh, there's no magic, is you're just scanning for, yeah, okay. I want people to continue to believe that way, because the less people understand, the setup will continue to work, right? So that's the thing which is on EP 9 million and this thing. So let's go back to our trade factory and see. So this is to find home runs and mini home runs, and I have some variation of these which I don't want to talk about because we don't want to give out all the H's, right? And basically, now on this side it is a very different thing. This is just a pattern based, and everything here is catalyst based. So I researched on that day what was the catalyst for sweet green, or I researched what was the catalyst for NFAs, or anything which shows up there. I'm going to go and research, and if there is a valid reason, and that goes back to the original first slide which I showed you, always find a reason for a trade. And when I find a reason, like on that day when those airlines, there was an apparent reason, right? The Iran thing was getting sorted, or there was a rumor of Iran getting sorted. So you always, when that volume happens, I'm always looking at what is the reason, and if there is a good enough reason, then I go into it. And many times it allows you to do a large size. That's the advantage of doing this. And then singles is just a pattern based trade. Something shows up and it's a very good, like in a low risk entry point, or something which is like this is a brainless activity. You just need to learn the pattern and do this day in and day out. I'll show you an example of this also as something which is called a momentum burst, which is a 3 to 5 days move in which stocks make 8 to 20%. If they are lower price, they will make even 40-50% move. Is like very simple kind of a trading this is. So here you look at this particular thing, right? And here. So on this particular day, I run anticipation scan also, which is looking for this kind of patterns. So this was like showing up like this, and next day it breaks out like this. So I don't even know what this company does. I do know what this company does, but just a continuation momentum burst, that there is a momentum, the first leg, but I do have a qualifier. Everything has a qualifier and context. So for this particular setup, which is what we call as the momentum burst, my qualifiers are if I'm going to be buying this as a continuation setup, which this was, the first leg should be 15% plus, right? The first leg should be linear, orderly. The pullback or the consolidation should be less than 10 days. Ideally between 3 to 7 days works best. So in this particular case, this was a 6-day consolidation. And during the consolidation, you should see series of tight bars, which is like 3 tight bars or 2 tight bars. At least minimum 2 to 3 is better, and sometimes 4, 5. And then the stock should break out, and then volume should close near high. Now these are trades which are just go up for 3 to 5 days. So in this kind of a trade, I buy it on this day, I sell it by 3rd or 4th day, 80% I'll sell. I'll just keep a runner 20%, move my stop to here. And in case it makes more, it's okay. If it doesn't, I am fine, right? And I made my money. And this might look like a small move to people, but like in 3 days, the stock made 18%. So it still moves your account, right? And 18% in 4 days, if I can do this 100 times in a year, 300 times, and I don't need to find one long move, right? And let others chase long. So this is an example of this. This is also an example of what is called as continuation setup or thing, which is like anticipation setup. So I scan for this, and then I look for this. So if I find something like this, I'll put it either in a watch list, or I enter this at around before market close. I do this work at around 3 o'clock, and I enter this at around 3:58. So that's an anticipation setup. Now let's look at an example of a reversal bullish, right? And I think Nova here might be an example here. So this is like this is what is a reversal bullish kind of a thing. So I have a scan which looks for reversal bullish. So on this particular day, if you see, it showed up in my scan. These are all scan based, right? And there is not much of a brain involved, just a qualifier. So this showed up in a scan on that day. It's a reversal bullish setup, right? And which is just an exhaustion. So there was a selling and selling exhausted. So it closed near high, right? And it's an exhaustion setup, I call it, like a minor exhaustion. There can be major exhaustion, minor exhaustion. In the context of where the stock is, it has some catalyst and all. This was a pullback. And then, so you buy this just before the close. I run this scan at around 3 o'clock, 3:30. And then whatever shows up, I buy. And this is what happened next day, right? Stocks make 11% in one day. Just what is my risk? Hardly anything, because I bought it at 358. Put a stop at half of this day, and next day it just it just goes and makes 13-14%. You sell them in 2 or 3. In fact, I sold 80% on that day, because 13% move, there is no way I'm going to let it go like that, right? And that's way beyond what I was expecting on that kind of a trade, and that's the end of the thing. These are just pattern based singles. You move your account 0.5%, 1%, but thousands of trades add up, kind of a thing, basically, right? So
is that typical for your sorry to jump in. Is it typical to put your is it typical to place your stop at the half day point? That's your typical thing for anticipation reversal bullish setup?
For anticipation, I might have a slightly stop might be say, but the anticipation setup which I focus on they are like up or down less than 1%, and most of the one which I select are like even up or down less than 0.4%. So my stop is around 1%. So even though the stop is not, so if they just explode, sometimes if it is a high price stock, and I have had cases where the stock is priced at $300 and it is up or down 20 cents, and then I buy it and put a $1 stop, and next day it goes up $18, $19. So it's just very short term free money kind of a trade, right? Basically. And I have more examples which I'll show you later of these kind of things.
Yep. So, for the reversal bullish, where it's a little bit more of a washout, you typically do like half that day's range
setup. So there has to be some sort of a washout. There has to be some sort of a selling cascade, 2 or 3 days selling cascade, and then there is a reversal bar. That reversal bar in Novacor, NVCR looked very clear and all. Sometimes it is, I can show you another example, Costco, and this is the beauty of these kind of trades, right? And basically that this trade which I did on this particular day was, when you look at it at this stage, it looks like this was a failed trade, or it didn't even make money kind of a thing. But this is what I saw, right? This was the reversal bullish on that particular day, because this is what I scanned for. So I entered just before close 358. Now my stop was very close, right? And I was just going with this is 1,000, this is 860 kind of a stop. And then what happened is next day, it started going up right from the word go, and it went up $11 or $12 before fading. I had already moved my stop, because it went, it's like you take that kind of a trade last night and you get that first thing in the morning, and then it faded. Didn't work out if you look at it in retrospect, but still made money. So means it's all really pattern based. There's no real this thing, but there is a background to this. I don't do this on a random stock, okay? This is done only on an institutional quality stock. This is not on a random stock. It is only on an institutional quality stock. And you see here, there's a reversal bullish. This is the scan signal. If it is, so here you see, and this one just like an event and exploded. But it only works on an institutional quality stock, because institutional quality stocks have buyers at support levels, or at these kind of things, right? And so I'd only trade it on select stocks which have a certain characteristic in terms of institutional quality, or I scan for stocks reversal bullish only on stocks which have 1,000+ mutual fund owning them. Okay. So not on any random stock. If you try it on random stock, you're going to get killed. It only works on this. And if you study that on an institutional quality stock, it happens all the time, right? And it's just, that's the way the market operates. If something on an institutional quality pulls back, there are buyers. So that's reversal bullish as far as I'm concerned. So this is the totality of the trade factory. Out of this is the focus in the morning, because the breakout kind of trades show up in the morning. Anticipation, I do this work at 3 o'clock, 3:30, and then buy them just before the close. I don't buy them next day. Okay. Because again, this is based on what I told you. I'm always asking who is going to be buying, right? Whom am I going to sell to? So I studied these newsletter writers. And most of the newsletter writers, what are they doing? They're looking at stocks with momentum, and they are looking for these tight areas. And then they're telling people buy when it goes up. This is the buy point. They draw a line or something like that, or they will. So I track some. I have studied some 1,000 newsletters right up there like this. Out of them, 300 to 400 are ex-StockB members running them. So I know what they are going to do next day morning, right? They are going to buy that when it breaks out. I just want to be buying before they buy. Same thing on reversal bullish. They do this work in the night and they identify this and they say, oh, this is like an doji or some thing like that, and reversal, and they buy it next day. So all that you're doing is buying before they buy. It's always buy before people can find out, right? Now that's what is an edge? Edge is just like 3 ways to make money in the market. Either be first, or be smart, or cheat. When you buy at 358, you are first. You are also smart, and you are also cheating compared to people who do it in the night. So that's like this totality of this trade factory in one slide, which explains what is the daily process or where the trades come from, right? Some trades come in the morning, some trades come in the afternoon, and this anticipation reversal bullish comes in near the close. So there is a time processing in terms of I don't work after 4 o'clock. I have stopped working after 4 o'clock. I just work from morning till 4 o'clock. After 4 o'clock, I do my personal things. So this process, which is called MTRT, which is night time is right time to find EP, which is to go through stocks which are gapped up, which are catalyst and all. I don't do it in the night. I do all of this in the morning. Combination of this. So in the morning, I'll start with what is gapping up, pre-market scan, look at, this is where you find EP, like in the morning, right? And in the morning, I also do other things, which is to create a situational awareness, to create a watch list of DEP stocks, which is delayed reaction EP watch list I create in the morning, review 20%, 50% study, and identify an EP. So that what happens in the morning. If there is something which is showing up, then I will do a OPG entry, or I will just do a stop adjustment on the things which I bought last night, anticipation, reversal bullish, and things like that. Now 9:30 to 10:30 is where most of my trades are found. And most of them are in fact found by 10 o'clock, because I'm a breakout trader. So I run EP 9 million momentum bus scan, and EP 9 million will start showing you 20, 30 candidates in the morning. The one which show up are the one which most of the time go on to make a bigger moves also. So immediately as I show, I will research, I will see, find out, and then keep on entry. Enter trades as they show up, adjust stop, and exit trades which you are carrying from yesterday or 3 days ago or 4 days. So it's a loop, it's a cycle, right? And basically, so then 10:30, I stopped, I run, I just move away physically from my trading this thing, because I have seen that when I sit there, when you sit at the computer and when you're running scan, even if there are no opportunities, if you make a monkey sit in front of a keyboard, he's going to press buttons, right? So I end up taking unnecessary trades, or the momentum or the bulk of buying comes in the first 1 hour. After that, buying slows. So you buy a breakout, it doesn't work the same way as what happens in the first hour or first 20 minutes. So I just decided that the best way is to physically intervene in this thing. I just go to the gym at 11 o'clock. Okay, so 11 o'clock is my gym session. So I go to the gym, 11 to 12, I work out, I come, eat lunch. 1:30, I run again the same rate, same setup, same scan. If I find some other EP 9 million momentum burst continuation setup, I buy them, enter trades, adjust stop, exit trades. Then at 3:45, 4 o'clock, I again come back and just run the ants and reversal scan. Because that has to be done at that stage if you want to get a very good entry, right? So I do my anticipation reversal scan at this stage, 3:30, around after 3:30, and then I wait till the last 2 minutes. 3:58 is when I'm going to enter the trade if there is an anticipation or a reversal. I don't do this process. This is just what I used to do, but like, and I do this all in free market. Whatever I used to do in the night, I do it. And after 4 o'clock, I do my other things. Okay. So this is a loop. The process repeats continuously through each trading day. All the scans are set up. Whatever I'm going to use for making analysis is set up. Everything is exactly the same every day. There is no change. This is like running a McDonald's franchise. Right. Then position sizing is a dynamic position sizing. It's not always fixed based on like how close the stop I'm going to be getting. Then I'm going to determine if I can I always come with the intention if there is a catalyst based, and if I can answer the question, if it has a clear catalyst, how much it is going to run, if I can increase the size, right? Because if you can increase the size on a trade, which was like in a year, you could have taken 20% and it would run 40%, you would make 8%. And if you can bump up the size, same trade will make you 15-16%. So I'm looking for this. So then for stop loss, there is a universal stop loss kind of a thinking which I use, and which is if I'm buying a breakout or very early in the morning, then I put a stop at low of the day. Okay. If I'm buying it later, then half of the day. And especially, I don't like buying breakouts in the later half of the day at all. But sometimes you end up buying because you're coming in fully invested, or you had like in positions, and then during the day you sold or you got stopped out, and then there is capital, and then you see something. So in that case, I'm going to look at half of the low of the day, half of the day. Like, and I have that made like in this thing itself, right? And so if you see here, in TC2000, and let's see, like say something like I'm just taking an example from yesterday. I don't know what to stock. So let's take Okta, let's say, which is a bad example because it has a long tail. But so here I have these things put in. What is the stop? This is a low of the bar. So if I was putting a stop, 107 is the low of that day, right? And stop half is finding out how much is the half of this thing. So stop half in this case will be 115.20. Correct. So this is all put into the system so that when I take a trade, I don't have to go and calculate. I can just quickly say, okay, this is 115.20. I'm going to put stop. Not exactly at 115, but near about that 115 or something I can put in. So I can find my ideas or trades very easily like that. So that's as far as stops is concerned. And I never move my stops down. I always move my stops up. Never, ever move the stops down. Always move them up, right? And there is just no, the moment you make one exception and move your stops down, game is over. I don't use this previous support resistance. This is like nowadays this AI fancy thing. I put in all these ideas and it just generated this for me. Okay, so it puts in support resistance. I don't really care about support resistance. I just put it at half of the day or low of the day. Okay. Same formula every trade. Never eyeball it. It's the same thing for any trade. Either it is going to be low of the day or half of the day, kind of a thing. For order execution, I'm looking for a limit order. If it is a must buy kind of a thing, I need to get in, then I'll use a market order. And if it is something which is like pre-identified in the morning, I did my research and I want to get in, I will do an OPG. Sometimes when I do an OPG, I get stopped out. But if I am convinced about the setup, then I go back into that particular thing later during the day after like it got me stopped out or shaken out. If a stock triggers and it meets my condition, I'm going to take it. There is no debate, and it doesn't take much of a time. This is all procedural memory. You see it, you buy, kind of a thing. If I miss a trade, okay, if I didn't get in early, I'm not going to chase it. There is no way I'm going to chase it. It is gone, it is gone. I want my stops to be for between 5% to 6% or less than 2.5% if I'm just going to be doing the just momentum burst kind of trade. I'm not going to chase it. No matter how good the idea, I'm not going to chase, right? And I'm James Bond. Okay. Have you seen in a Bond movie, Bond chasing girls or girl chase Bond, right? So I don't chase. I'm going to wait. If I lose, fine. There is always next trade, right? Stop loss, set immediately on fill. So as soon as there is nothing which is mental stop, there is everything goes into the immediately. And if a trade moves in my direction, after I enter, within half an hour, it goes say 4-5%. I'm going to always look to increase my stop. My first objective is to get my stop to break even or break even plus, because then the trade is free, right? And sometimes I move my stop because you enter and some of these breakouts are very explosive. They immediately go up 8-10% after entry. I just move my stop because many times they just then end up giving up the gains also, right? Anyways, so stop loss immediately on fill. Then profit taking. Again, I have any EP or EP 9 million, if I'm going to be entering, I still have this framework, which is these trades are going to be either in duration term between 3 days to at best 20 days. Because I have studied 100%, 200%, 300% moves. And if they are going to be magnitude moves, they can make that 200, 300% move in just 3 days, 5 days, or 8 days, or 10 days, or 15 days. So my thing is, I always look at doing. Now, if I'm going to doing an EP 9 million or a DP, I always have a target in mind, saying based on this, say when I got into Love, which was one of the turnaround kind of a play, the Southwest airline, and I looked at it, and it is a turnaround. So I thought the guaranteed move on this is 20%. And because turnaround tend to last for a longer period of time, it can keep on going. This can end up into a multi-week runner kind of a thing. But I moved my stop on 20%. When it reached 20%, I really moved my stop to protect 20%. And it so happened this whole Iran thing and all started, and the thing collapsed, right? So even though I had a profit which would have been higher, I just ended up making 10%, 20% on that. So I always scale out, right? And I scale out trades. So if I buy a pure momentum burst, say something like this, HAE, if I buy, I'm going to be definitely selling it by third day or fourth day, right? By third day, I would sell 40% or 20%. I'll move my stop just not even half of this day, because this is already a 5% kind of a move. I'm not going to do. I will move my stop just in a 1/3 of this move kind of a thing. Next day, it start going. Then I start moving my stop aggressively. If I'm there in the office, if I'm going to be walking out of the office, I just trail. And the trailing rule which I use is once it has gone this much, right? And this trade, let's assume that I didn't enter at the end of the day, I entered earlier. But once I have what I expect 10-12% kind of a stop, I'm going to start trailing very aggressively, or just sell 80% and keep a 20% in case it runs. The trades all exited on third, fourth, or fifth day, depending on how they run. Basically, there is nothing which I'm going to hold beyond that. If there is something which runs, and once I exited, it runs, it's okay. I am not worried about that. 3 to 5 days, right? That's the unit of moves. All these stocks move 3 to 5 days. So that's as far as this is concerned. So profit taking, sell into, so everything is sell into strength. I don't sell everything together at one time. I'll sell 20% of my position, sell another 20%, sell another, and sell another. So this is why what I do is I have bought one of those cheap pillar which you get on Amazon, and I keep it on my trading desk to remind that to fill your position, because I've seen many positions which are 20% profit. If I didn't sell them, they just end up giving up that gain. So I sell 80%, keep 20%. Within that 20%, I'll sell another 40-50%, keep small. Sometimes I have a very small runner which goes for 5, 6, 7 days, but nothing like that kind of a thing. If I'm taking EP 9 million or something, I always have a target in mind, 30-40%. If it makes, I'm going to be more aggressive. The rule of my stops is that if something runs faster, I should move my stop more aggressively. If something runs slower, I should move my stop slower. So if something starts running faster, I will go. And if I was trailing with 3%, I drop my trailing to 2%. If it starts even running much faster, I drop my trailing to 0.5%. Sometimes I drop my trailing to 0.5%. You get stopped out, but in the meanwhile, it can go. So the higher the speed of the move, the lesser the trailing you use. That is the general principle which I use. Most of the time I get stopped out on trail. So basically, hard stops only, no mental stops. Then I have also a rule which is like if there is some certain percentage loss for a day or 3 trades in a row, which I bought breakout and they hit my stop loss, I just stop trading. Because I know something is wrong. And this is what happened a couple of days ago. I had like an NVIDIA, I had, I think, what else I had, like CL or something. 2 or 3 trade. I had B, I think, and 3 trades I had. And all of them got hit. First thing in the morning. By 10 o'clock, I said, like, there is something wrong in the market. I don't know. My best option is to just like walk away and protect my capital. And good that I did that, because next day the whole market collapsed and everything, all the open profit would have been wiped out. I just have that rule. I know because I keep track of situational awareness. So I was not expecting something like this. 3 trades in a row doesn't work for me, means I have a problem. So that's... and I don't mind closing. I can reopen position. I don't have this whole thing, oh, you keep on holding and all. No, just like protect capital at any time. You can always find opportunity. So everything is like same routine. So this is a muscle memory. I can do this in my sleep. I don't need to worry about like Magna 53 cap 10 by 10. If I explain, I'm saying this. But when I look at like I can do this in seconds, right? And if I had to calculate stop, I know where to do, if I had to move. So all this is this. The broker platform which I use is I have multiple brokers nowadays, because there are some different kinds of accounts I have personally. So I have Fidelity and Interactive Broker as the main brokers, but I also have Schwab and some other brokers for some other accounts. Charting, I exclusively use TC2000 and Market Search for like the financial data. News sites, I use briefing.com, Finviz. And nowadays I found that the best way to find news is to just like go into some AI platform and just put in the ticker, and I have some scripts written, so they just like go and find out from some sources which I said like find out on Twitter, Reddit, and this reliable news site WSJ, this Bloomberg, this, and then they give me what is the news on this particular thing, kind of a thing. So that's how the goal is: make execution mechanical, every action predefined, and repeat it until it's a muscle. That's the idea, basically.
A quick question before you move on, Pradeep. Sorry. Going back to position sizing, how much of your account are you willing to commit to the home run type trades versus the single type trades, or is there a difference? Basically, what are you
for a single
targeting?
kind of a thing, I'll do 20 to 25% of my account, right?
Mm-hmm.
But if I'm doing an anticipation where I'm taking an overnight risk, then I'll reduce it to around 10% to account for some time, like, and it can go against you, so I cannot go like in a crazy kind of a thing. And if my situational awareness is like, say, look, and it's like really the market is likely to run like a couple of weeks ago or a couple of months ago, when the T2108, which is one of the things which I'm going to discuss later, which I use, which is what an indicator, was below 20, I was expecting the market to explode. So that time I just went crazy, because I knew even on a normal trade, if I found, I was just trying to get in, because the idea is when the sun is shining, capture as much as possible. Now, currently, when we are doing this particular thing, my situational awareness is this is choppy market, range bound, very, very difficult market for breakout. I'm not even 5-10% invested in this market. But even if I find a breakout, I buy it just for like testing out an idea. But if the market is, at times, if the market is good, I will, even on a normal just single hit, I will go 60-70% also, because it's just quality of setup and your confidence in the market at that stage. But for something like EP 9 million and EP, I'm trying to get, means like for GLW, I had like a really big position. Even for CRCL, which I bought through CRCA, I had a big position. Even for some of the other institutional quality thing, which like for NVIDIA, the day I got stopped out, I had a position which was like a huge position. Basically, in terms of on margin on that day between the three positions which I had opened. So I want to put as much as possible on the institutional quality stock. I will not do a large position on non-institutional quality stocks, especially stocks like Google or like an NVIDIA or Oracle, which I traded multiple times in the last quarter. Means I don't want to even say, because people start getting scared, right? And basically, but that's the game, right? So if you can't do size, I made a video also, right? And you must have seen where I said size matters, right? And that's really what this game is once you're on edge, right? And obviously, if you don't have edge, then it doesn't matter. And plus situational awareness.
Right.
Obviously, everything is situational awareness specific.
Yep.
So this I
Perfect.
can skip because I explained this already. Okay, go ahead. Whatever.
No, that's all good. I think it was a great summary.
This is just what I explained to you, like EP classic, neglected names, game changing, but doesn't happen. This is what I really like, and looking at the volume is the footprints of institution. That's the hypothesis. Then you go and find why this stock is trading this kind of a volume. It's like trading in the top 2% volume. Most of the days it is not even 1.5% of the, and sometimes you get like, they are trading in the top. Why are they trading that kind of volume? Then just to find, is the catalyst worth finding? Filter for noise. I don't go into this low price, like there are a lot of these low price stocks which will do that kind of a volume, like if you see CRC or Corsair or something which did like a huge volume, or I research them always, because if I can research a catalyst and I know the catalyst, later when they become higher priced and when they offer opportunities, I can get into them. But I'm not going to trade things which are $3, $5. Sometimes I do, but the size doesn't really is big. Like I'm not going to buy 100,000 shares of a $5 stock. No, never. Okay. And then DEP is something which is like, let me get into a little bit into this DEP, because this is another one of these things which I use a lot nowadays. So DEP is, again, I'm only focused on DEP on a certain kind of stocks, not on everything in general. So what I do is I just focus on two types of stock. One which is owned by 1,000+ funds. This list I pulled from Market Search. So these are stocks which are owned by, and on them I'm looking for EP 9 million, which has happened in the last 1 month. So DEP is essentially a setup on an institutional quality stock, or a stock which has a genuine catalyst, and which had, after the earnings or say whatever the catalyst which happened or EP 9 million happened, I'm looking for a lowest risk entry point after a shakeout or a small pullback, which happens within the 25 days of the catalyst. Okta is a classic example. It has a catalyst. It made a EP 9 million, and then it still has a valid catalyst. And now this is what is a DEP. It was on my watch list like yesterday, coming into yesterday. I had this is how it looked yesterday before this, right? And so it was setting up probably for potential. I had Snow. Those are the two stocks which I had on a DEP, because again there is a catalyst and orderly pullback after that. And this particular stock, while we are on it, 3 times I entered this stock. I have a rule on DEP that because if I'm convinced that there is a genuine catalyst, I give it 3 tries. But my stops are so close, my entries are so good. 3 times on this day, it looked like it's breaking out. I entered, I got stopped out. This day I entered, I got stopped out. And third time I tried, I think on this day, and then It's just, there are some stocks which are just like that. So if 3 times I try and it doesn't work, then I just wait for a confirmed breakout to buy, and I just don't do any more harm to myself, right? And I feel it.
Yeah. Question on Snow actually here. Yeah. Question on this. Can a chart get too tight because it was just tight for so long here? Is it more prone to a shakeout in your experience? And you kind of, like you said, you kind of wait for the actual confirmation of the breakout in that situation.
When I see chart going sideways for too long, especially beyond, like the one which really going to work, they break out in 3 to 5 days. I will show you example like TXN broke out in 3 to 5 days. So GLW 3 days and it broke out. So what this tells me is there is no urgency on part of the institution on this particular stock, or they are not convinced that this catalyst one earnings quarter is sufficient for them to get involved in this particular thing. So there is a clue. And I was very bullish initially. I thought like, this is good. I'm less bullish. So sizing terms, in terms of what I expect now, it's so. The one which break out, look at this, right? GLW on earnings, 3 days.
Yep.
Right? TXN, which is like another GEP, like 3 days, 4 days, it just goes, right? And there is urgency. So this Okta, there is I think DOCN or something, Digital Ocean or something else. There is nobody is really believes in this catalyst according to me, right? Or they're waiting for the next quarter or something like that.
Right. Makes sense.
Yeah, this is another stock which I tracked, entered, nothing happens, entered again. So I have these 3 rules. Okay, look, and if you go on a date 3 times and nothing happens, you just like and move on, right?
Yep.
You're married, so it doesn't matter to you.
Fiance, but not yet. But yeah, same idea.
Okay. I thought you're married. Okay. So let's go back and look at this. So this is just a summary of what I discussed. DEP, I'm looking, and the difference between EP 9 million and DEP is DEP trade is always from watch list, and it is like I only have 3 or 4 stocks which will meet my DEP criteria, which I'm watching like a hawk. I will put everything into my interactive broker. I'll even create a market order or a limit order ready, and I'm just watching. If I see a sign of life, I press it button. So sometimes I enter but then this is where you can do size, because you are like watching, like on that GLW, I could do the size, which was like a crazy size, because I was just like watching. As soon as entered, stop was less than 1%, right? And it just went after that, free money. So this is watch list based, all the work which I do. And now this also in terms of working on this, I don't do any more this DEP work in the night, which I used to do, or in the morning. I moved this process to 3 o'clock, because then it also allows me sometimes, if everything is setting up, so I just like enter in anticipation, gives you a better entry, and then you can add more next day if it really breaks out. If it doesn't, you take a small cut and blame somebody, and it's always better to blame Trump, right? So we went through this momentum burst in just 3 to 5 days. Within momentum burst, I'm more focused on the higher price stocks. So I'm not really looking at these lower price stocks, 8 to 40% kind of thing. I focus more on 50 to 300. Plus, one of the rules which I've done, especially since this year, is I really don't even trade momentum burst, which don't trade 1 million shares on an average, right? Because liquidity is becoming so important. I need liquidity. So I don't even trade a higher price stock. And if you look at the mathematics of higher price stocks, returns are higher in terms of R's on higher price stock than on because you can get stops which are very close. I can get into a high price stocks with just like 2% stop. So small moves can also pay off. So this is all based on structural tendency of market, where the market moves in 3 to 5 days. I'm just looking at start of a swing. The signal is large expansion bar. That's all there is to it. So this is all hitting singles, looking. One trade is not going to make your year, but hundreds of trade make your year. And in case something doesn't work out on the other side, you still have continuous set of money coming in. Then for everything, there is a criteria if I'm going to do, or there is a classification of breakout, because not all breakouts should be traded same way. After a lot of years of experience, I know a breakout which is a continuation, which is like where it had only less than 10 days or 3 to 7 days, is a different quality from something which is a consolidation. Like we saw DigitalOcean. On a DigitalOcean kind of a thing, if you just get a breakout and you get in very excited saying, oh, this is a long base, and then it's going to, most of the time when you buy a breakout on something which is having more than 3 to 4 weeks of consolidation, more longer consolidation of months and all, unless there is a catalyst, clear catalyst for the next leg, you buy a breakout which looks perfect. It will have a cup with handle, VCP pattern, whatever pattern you draw on it, and you buy it, and invariably that thing is going to go squat and go back into the range. So I have a qualifier for buying a consolidation breakout. I only buy a consolidation breakout if there is a catalyst and a volume surge. But while for a continuation setup, I don't need volume, because the volume has come in the first leg. There is already aggressive buy. So here the criteria are two lanes, which is like the stock should not be up 2 days in a row, linearity, young, narrow negative day, consolidation quality high. Here I say, like, and I always tell people, like, if there is a consolidation breakout, and if you just buy it because it is a consolidation breakout, you're going to spend a lot of time in heartbreak hotel, because most consolidation breakout don't follow through unless there is a catalyst or a volume. So then the qualifiers, what I call qualifier for a consolidation setup, I'm going to qualify using catalyst and volume. And then bottom bounce, I showed you like NV core and all. I'm just looking for some sort of an exhaustion. I'm looking for whether the market itself is going down and there is a turn in market. So because when the market turns, you're not going to get continuation and consolidation setup. You get these bottom bounce kind of a thing. Let me show you an example of this. When the market turned after the Google, this was a bottom bounce, right? It was like a stock was going down, everything was going down. On this day, the SPY also turned, a Google turned, and every single stock, means you could have just like that day, if you ran a scan, you were feeling like you were Saudi Sheikh in a harem kind of a thing, right? And every stock was looking like this. But this was a bottom bounce. So this particular day, this was the start of a swing, EP 9 million, but it was coming in from bottom. But I was perfectly okay buying it, because the context was T2108 was below 20, and the overall market itself was also going to be turning around. So this setup I only trade when the context is right for this particular. And that day, every single stock, large stock looked like that. You could have bought any one of these stocks, Nvidia, I think Amazon, AMD, bunch of them, like all, even the thing. So that is the context. Always like always look for a context and a criteria. What is the context for this particular stock? So then weak structure short, which is a short setup which I trade, not such an important setup, because you get enough in nowadays. I get so much opportunities in EP 9 million that I don't even have money to do most of the time some of the other things. But this is a short, weak structure short kind of a setup where I look for a stock which is very weak, which sells off 3 days in a row and just has 2 or 3 days of pause, and then it starts selling off. So I have criteria for that also. This is all singles, all like just pays the bill, keeps the cash flow going, creates cash flow for putting in larger size. If you find some idea like GLW or CRCL or something, and you need to take a larger risk. So this is, but I'm not going to stop doing this, because this is very good. It gives you practice. It keeps the register ringing, right? I like my register to keep ringing. What else is there after this? Yeah, reversal bullish. I talked about reversal bullish, anticipation setups where I look for 2 tight bars or 3 tight bars, decreasing volume, net change less than 1% or something like that. And this is a situational awareness. So every day morning, first thing when I get up, I'm asking, and this is why I got these things done, this kind of like things, are breakouts likely to work? So if the breakouts are likely to work, I keep this wooden thing on the right hand side. So if I put it on the right hand side, I know to buy breakouts. If I put it on the left hand side, that means just tie your hand and sit on your hand. Okay, so are breakouts likely to work? Yeah, okay. So then you go early, you try and find breakout as early, you do large sizing. Then there is market environment where like some breakouts are working. So you have to be very selective, trim size, do lower size, have a lower profit expectation. So I go in with a very low profit expectation. I drop size. I like and very, very careful in terms of taking a breakout. And when breakouts are failing, I don't even trade, right? And basically, so this is a framework for situational awareness. And the input for this comes in from 20% study, which I do daily, market monitor, my own trading, how have the last 2 or 3 breakouts worked, what am I seeing in other breakouts. So this is just a framework, but this is very important. This is the key to success in breakout. Breakouts have a inherently very small edge, right? Most of the time buying breakouts is a terrible business. You're not going to make money just blindly buying breakouts every day, right? But there are times when it is a very good business, where like every single breakout you buy, like on that day when the T210 was very low and the market itself turned and all, everything you buy worked, right? And it's like literally everything, you could randomly throw a stone and buy any breakout and it worked. And then there are times like now, people are getting frustrated. And I told them, I did a video on my site last week, warning them that saying, look, this is going to be a London weather. You're going to get fog, dark, dingy clouds. Don't go and wait. But people don't have patience, right? They want to trade because they see setup. And the other thing is that when the market is, when breakouts are failing and when things are not working, a good breakout is still going to look exactly same like a good breakout looks in this market condition. If the market is selective currently and everything is not working, terrible things are happening, right? And you run a scan and you see a breakout like HAE, it is still going to look exactly like HAV. It is going to look perfectly fine. But the situation is not going to allow that particular thing to work. There are a lot of people are so frustrated. Some of the people bought like yesterday Marvel and then it sold off, and some days ago they bought and they're just complaining. I keep telling them, hey, I operate with situational awareness. That's your best strategy in life. So this is as far as this is. So let's go and look at some examples before I take some questions from you, and then we'll look at some examples. What are your questions here? You can ask. These are just random examples of some of the trades which I did.
Yeah, could you actually show your market monitor and kind of walk through how you look at it day to day and what things you're considering?
So here, this is just, means lot of these columns is bloatware, right? And initially I had only these 2 or 3 columns. So now people say, why don't you track this? Why don't you track this? Why don't you track? So it's literally only thing which I look at is how many, is buying coming or selling coming into the market, right? And basically here, there's a bunch of buying, or let's look at when the turn happened on that particular day, when there was a big buying came in, right? And buying came in, and buying came in, and buying came in. So breakouts worked. Buying came in, everything was working at this time, everything was melting up. Selling came in, big selling came in 972, and then selling. And now in the last couple of days, again, little bit of a buying came in, which is typical of a range bound kind of a action, right? And basically, so that's how this is and basically. Now, these ratios and all, stock B members are added. I don't even pay attention to those ratios. There is no value in those ratios according to me. They're just a ratio of 5 days of this buying to selling kind of and 10 days. So I don't even, but this is important. In general, as a thumb rule, when the primary indicator or the percentage of stock, number of stocks of 25% in a quarter is green, that means more stocks are going up than going down. It's a good environment for breakout trading, right? But this particular thing is not the only thing which I am going to use. In fact, I rely less and less on market monitor than another indicator which I have created, which is again market breadth only. But while we are at it, look at it like this. The T2108 is a very good indicator. It's an extremely good indicator. It is the percentage of stocks which are trading above their 40-day moving average. And it only looks at NYSE stock. It doesn't look at the other stocks. So it's like looks at. So here you see this. This is why I was like screaming, saying, look, the market is going to turn, market is going to turn. When it goes below 20, it stays below 20 for a very short period of time. Every time it goes below 20, if you bought Soxal or if you bought TQQ, you are going to make money. Because when the market gets so oversold, buying just comes in. And this is exactly what happened. So this T2108 I have to pay attention to. There is another indicator which I pay attention to, because everywhere, if you go on Twitter, everybody is saying, oh, there is a bubble, there is a bubble, there is a bubble, right? I know what a bubble is, or what is the indicator which will tell you there is a bubble. The one indicator which tells you there is a bubble is the absolute number of stocks trading in the market. If it increases by 800 to 1,000 in a year, there is a bubble. And you can go back and check this indicator. When number of IPOs increase by 800 to 1,000 in a year, then typically that is a bubble. So I watch this. It doesn't move on a day-to-day basis. But if you go back and look at this, during the COVID-19 time, if you see 2023 or somewhere around that time, it jumped by around 1,200 because those 1,200 SPACs came into the market. Before that, there were only 4,000 stocks trading in the market. And then that's when the market corrected, right? And that's when everybody got into trading, because they come in only at the bubble. So these are some of the things, small nuances. Now this is converted into some sort of a green light, red light kind of a thing. If the green light is a buyback out, but it's not as simple as that, because I also look at the context of the market. And the context of the market which I look at is driven by this particular thing, 20% study. This is SPY versus the number of stocks, even common stocks, which are 5 days, 20% plus. So this is like looking at stocks. If you go to the scan, you'll see that it's looking at a stock which is priced above $5, about $3, and which are up 20% in last 5 days. So this is like an oscillator, right? What I have seen is that when it goes to this extreme 200 and all, not immediately, next day selling comes in, but invariably when it goes like this, you get some pullback in next 5 to 10 days. So it's like a warning signal telling you, like, this is why on the StockBee site, we were like very cautious. I said like, no matter what people say, this time is different. It is never different. The time is different because market is already made like some 20-30% move, which is historical. And this indicator is screaming, it's 200, right? And we are ready. Okay, look, in case like there is selling, and I had like almost like put stops very aggressively and all, and this is what happened. Now this indicator also needs to be interpreted in context. When T2108 is low and when it goes above, I don't really pay attention because I expect that to happen because market was oversold, so it's going to come in. So I'm not going to sell at this first sign. But third time, when it reaches this, and especially about 100, and the good thing about this is like you can see it. It's here. This means like you'll see this on the thing. Like every time it goes in a small period of time, at 3 to 5 days after that, there is either a minor dip or a major dip after that, right? It works the same way, reverse way. If it goes below 20, like on this particular day, I was like bullish, and I said I'm bullish, and I even posted on the timeline on my site saying because this is below 20. The number of stocks which are up or down was 17. So when it like reaches extreme low level, then buy. So this is like a mean reversion kind of a thing. So this is one thing. So this is another situational awareness, and this is the main tool which I use nowadays, like market monitor again, yes, but this is the main 20% plus study. This is something which you can only do this in the highest package of TC2000. You can't do it in a regular package. So you need the whatever, earlier it was called Platinum. Nowadays it is called some Premium Plus or whatever, right? And so it's done. It charts the number of stocks which are up or down, and this is just a combination of them. This is one thing. In addition to this, I have this framework in terms of thinking, which I call at like T3A and T30A, which is think 3 days ahead and think 30 days ahead. So when the market is coming out of something like T2108 is extreme and all, I am not even worried about a market correction because I know for at least 30 days it is going to go up, right? That's not when you need to get worried. That's even minor pullback is going to get. So if this reading get higher, I'm not really worried and all. But once it crossed that 30 level kind of 30 days kind of a thing and all, then I said like, okay, just never say never. Anything crazy can happen. The market can go and make another move like this. As somebody keeps saying, look, can a marathon or run another marathon back to back? In theory, yes, but in reality, unlikely. So it will transition into a chop. So I have been saying this for some time, saying this market has transitioned into a chop. So that's my T30A now, thinking 30 days ahead. This is going to be a period which is likely going to be like this, or going to be a period likely, because that's what happens after a big move, going back historically, or this will be a period like this. So now, if this is my thinking, it is reflected in my trading. I was very aggressive buying things here. I bought bunch of stocks, 150% invested on this day when the breakouts, and they all like work for 3 to 5 days, and then I am out of most of them. So it's just a framework for thinking and decision making for situational awareness.
What goes into the T3 ahead, the 3 days ahead?
It's always determined by where we are in the phase of the market, right? And where you are like, and I say this, there are a lot of these small things like market is down 3-4 days in a row, right? And you know that it's going to bounce back, right? And so you don't get, people got very aggressive shorting on this day. It's like, no, you don't get aggressive. You want to get aggressive, you go on the first day or like something like that, right? So now after it went up 3 days, I was, and in fact I can show you on my site, I said like on this day, in the morning when I do the morning meetings, I said like, look, this is another day, I will give it, and I'm very cautious. I'm not really bullish here because I think this move has happened 3 days. Most of the stocks have already made 10-20% move in 3 to 5 days. They're not going to keep on going. So I'm very cautious, and everybody is saying that you're a CC, you're a pussy, you don't like, no, stocks keep going forever. I said like, I'll rather be a pussy than risk my money. So I reduced my exposure. I had a very little exposure, and then yeah, if you start this at first, I didn't have all this knowledge or understanding of market when I started. I wish I had, right? But more you do it, you can see this is over. This game is over. This party is over, right? This is going to transition into, I have seen this for 26 years. This is not my first rodeo. I know that this is likely to go into this kind of a thing. Yeah, I'm ready in case it goes, and I will put in money because I have set up a trade factory. But I think this will transition into some chop and death by 1,000 cut. And invariably new traders enter the market because everything has been working, and then everybody tells them, you just put a stop at 10-day moving average, 20-day. You should not trade for magnitude, you should trade for duration. Everybody gets sold on duration. At this stage, everybody was telling everybody and their cousin that you should be a duration trader, right? Seen this for 26 years, man. Seen this for 26 years. So this is going to be chop, according to me. Obviously, I'm willing to change my mind. I can change my mind on a dime. I just don't see how it will like transition into some, unless there is a time which goes sideways. So I'm trading accordingly, right? I buy inventory, big inventory I bought, sold 3rd day, 4th day, sitting in cash, welcome the cash, waiting for another opportunity, right?
Could we go, did you have something else to show, or?
Yeah, you can ask anything. I just wanted to show T2108, yeah. Like, and I say this goes below 20. I'm telling you, every time it goes below 20, if you just like start getting bullish and not getting bearish and not believe all the end of the world scenarios, you'll make so much money. When this was coming out, I bought Soxal, right? And because I was like just waiting on Soxal, and then that Soxal made this crazy move, right? I bought TQQ. When it started turning that day, when the breadth the thing happened, this thing made a crazy move, right? I was watching Koru, and I like, because the Koru was going crazy, right? And so like Koru, and that the thing made. So if anybody like T2108, I always tell people, right? And if T2108 goes below 20, start getting bullish. If it goes below 10, you should be extremely bullish. And if at all it goes into single digit, sell your wife, kids, donkey, horses, whatever it is, and buy the market. You're likely to make money, guaranteed.
Great. Could we dive deeper into the glow trade? Because it seems like a little bit of a standout trade for you. And I'd love to also
right?
talk about the GLW. And I'd love to yep.
Okay.
And if you could talk about like putting out your exits too, that'd be great.
Okay, so what happened in this particular case is like, and this stock was going sideways, right? And this is I had looked at this stock every time EP9 million happens. I always look at it. So I had like looked at it, but it is not a very fast moving stock, or it is not something which is like got me excited and all. But on this day when the earnings came in, right, and there was also news that they have a Meta or somebody has signed up with them. So I researched it on that day. I looked at it. And then I realized, look, this is no more that Corning company which I had seen sometime. I had gone to upstate New York and I have seen this factory and all. This is not that same old glass company. It is actually getting a lot of business from this AI kind of a thing. So I looked at the earnings, sales. I looked at all the things which were showing up there. And I said like this particular thing. And if you see the earnings, somewhere I should be having market search. Where are my things, right? And I looked at all the things and I said, okay, this is something which is likely to make a around 40% kind of a move, because it was like it had a earnings acceleration, sales act. And I am a sucker for sales acceleration, but like it's not a kind of a company, it's too large, right? And so, but for the kind of business it is 17, 14, 15%, it was projecting, it had like this, it was growing, hardly growing 14, 15, and it had started acceleration. And not only the acceleration in earnings, but also they were getting these orders. And also I said, okay, based on this, based on all the information which is in front of me, this is likely to make around 40% move, kind of a educated guess kind of thing. And then like, and I bought it, and I like, and when it started going around 40% and all, I started tightening my stop. And then on this day, I had sold like 80%. I was holding a runner, and then this happened and I got stopped out. So one of the things which I look for is like typically on this kind of plays is the first range expansion to the downside after my entry. So this is the first range expansion that told me that there is no point in just sitting in this. Probably this is over. And then I tried again. But here is the other thing also. The catalyst have a lifespan. This catalyst again didn't work. So that's another thing.
Did you take a partial the first few days of this as well, or
no? I didn't take a partial. I was like very bullish because I was, and that's why I put in a larger position. Even in the case of this CRCL, which I expected a 50% move. When I looked at it, I said at least 50% move is going to happen on this particular stock. Right? So when it started approaching that kind of, and I was not playing with means after the first day's move, I was expecting another 50%. So now I was playing with the CRCA, not this one, but I was tracking this for my targeting. And I said like, look, man, this is like good, right? And this has reached my target. So I sold 80% and I said like 20%, if it keeps going, I'll keep it. And I had to stop at like here half of the day. And then I got stopped out on remaining. And just lucky also like after. Means there is no point in holding. These moves are not, means all my trading is designed for these kind of moves. If I had to do something and hold it for 3 years, 6 years, or 3 months or 6 months, I will completely redesign my trade factory and do a different way of doing this, right?
Excellent. I'm sure you get this question all the time, and people are probably asking it right now. What really separates just a normal gap from something that can be an AP? Again, I'm sure you get asked this all the time, but it'd be just good to clear that up.
You need to see something which is like stares at you, which tells you that, hey, there is a massive acceleration. This is why the first thing which I look for whenever there is a thing is which is massive. It has to be something massive, right? And like something which is a game changer, something which is out of ordinary, right? And something, either a massive theme or a massive acceleration in sales, earnings or massive order or something big, which is like a CFO leaving the company or something which is big, right? And basically massive. Now here look at like this CRCL, right? There's a people at very low and this works only if there is a low expectation, right? And basically if people have high expectation, then it doesn't really work. Very low expectation people had. This is like IPO'd. After that, it is like in the dustbin of the market, and then it comes and surprises the market. Then it happens like that. Or there is a government policy change, right? And here MP, this was like a stock which was like many years ago. It had made a move. It was in the dumpster of the market, and then there is a catalyst was comes in, and suddenly one day you see that government is taking a stake. That was a big shock. That was like, and also the volume told you that also, right? Even in this particular case, I didn't buy it on the first day. I bought it as a DEP on this particular thing. So it's the massive it's a game-changing catalyst, something which is like let's look at like a recent example, which like people called it an EP, and people call everything an EP nowadays. That is because they just like now this CBRL. And I saw like everybody saying this is an EP, this is an EP, this is an EP. Yeah, means like I look at CBRL, which is Grackle thing, right? And which is that thing. I looked at its earnings and sales. Means, yeah, big deal, man. Like they had what? Like this is like minus 5%, 3%, 5%. It's like okay. They might be turning around business, but that's not how a turnaround looks. What does a turnaround looks like? I'll show you an example of a turnaround. And everybody is scratching each other's back and kissing their cousin and telling this is a turnaround. This is what a turnaround, real turnaround looks like. Here, there is a real turnaround, right? Company comes out and declares earnings, says we are having 244% profitability and we are projecting for next few quarters, our sales growth is going to be 18, 20, 21 for the kind of size and the Abercrombie & Fitch is a very old company. And before that, it was doing nothing. It was doing minus 7%, 4%, 1%. So context was that, okay, this is like an acceleration, right? So that was a massive turnaround. And that's why the stock went and kept on going up. And I saw some of the things which Twitter people were asking. You asked them what question to ask them. They said, we want to trade duration moves, right? And if you want to trade a duration moves, you want to find genuine turnaround, because genuine turnarounds, if a company does a genuine turnaround, which is what happened in the case of Abercrombie & Fitch, where like there were a lot of factors, right? CEO had an affair with some guy and wrong products, and that preppy look, Boston looks went out of fashion and things like that. And then they managed to turn around, right? Now, when they do that kind of a turnaround, this is not going to be one quarter, right? It's going to last because they fixed something in their business. So it's going to last. Or very recent example, if you want to see here, Love, okay? Which is Southwest Airlines. If you remember the history of Southwest Airlines in last 2 or 3 years had terrible problems. One time their software froze, they couldn't like run flights, everything was a mess, competition from all the other airlines, you name, and they had problems, right? And then they did something, right? And you see now they are projecting sales growth of 18, 19, 440% profitability. So they really turned the corner in terms of getting things right. Obviously, this happened because of the Iran. If the Iran war would not have happened, I am sure this stock has made a real turnaround in business, right? And this is why it is a turnaround EP. Now, when there is a turnaround EP, if the company has done a genuine turnaround, that is going to stick, and it's going to last for a long period of time. But you have to understand, and this is why I recommended a book, and unfortunately, I was just like responding to somebody, and the moment I recommended that book, there was a run on that book, and the book is no more available. But there is a book called Stock Market Blueprint, right? And it's a very old book. It's like, I think, a 40, 50-year-old book. But in that person gives you a good framework to think what is likely to make 500% move and turnaround. Cyclical turnarounds are going to last for 1 or 2. There's a cyclic, like here is an example of a cyclical turnaround. And in cyclical turnaround, there is not going to be necessarily immediate earnings going to reflect that. But here, if you see Dow Chemicals, right, going down, was in the dumpster at the beginning of the year. This was the worst performing stock in S&P 500, right? And then all kinds of problem. Chemical industry has this problem. Chinese are getting their lunch. This is that and all. And then now there is a turnaround in this cyclical turnaround, right? And this is a cyclical turnaround. This is not, it's like the cycle has turned because of all these problems. Chemical industry shrank, they reduced costs, they did all this. And now that turnaround has happened. And this stock has made 91% more. So you need to have a framework for thinking for anything which you do like that. So massive is relative. What is massive for Dow is not massive for SNDK. In a technology kind of a sector, what is massive is going to be what you see in a SNDK earning, which is 4-digit or something like that, right? Or move earnings, which is very different than what you see in a retail. If there is a retail play, you don't expect turnaround is going to be 20% growth rate.
Excellent. Perfect. So I think that was most of the questions I had. Did you have a few other examples that you wanted to run through? We've already covered a lot, but
like,
were there any
I'm
other
just
key
going
ones?
to run through some examples to that gives you visually a lot of like ideas to people, right? And this is like a momentum, typical momentum burst, right? And this is just a pattern based kind of a thing, and then it makes like this 8-9%. Sometimes like in a Koru, I discussed Koru already. HAE, this is like an example of the kind of trade I always look for. If something like this comes in, I'm just going to buy it. I don't need anybody's permission to buy it, right? This is Circa, which I told you for the, whenever there is a triple ETF, I find, and there are like, this is what I look for in a continuation setup, right? Tightness, 3 tight days, and then it coming out. 3 or 4 days tightness, and then sudden range expansion. So tightness is very important. Tight. And that's what my mantra is. Again, like this is a momentum burst, first leg, and continuation setup kind of a thing. This is like instead of trading AMD, I trade AMDL. So if you see this hut, now this is an example. On this particular day, there was some catalyst, and I researched it. I said like I am not going to chase it because I didn't get, and I didn't know even realize this catalyst is important, right? This is the other advantage of EP9 million. But when I researched it, I knew this catalyst is good. So I was waiting, and this is where I got in, and I got as a delayed reaction. So this is also example of a delayed reaction. EP, this is Forgent Power, which is an IPO. Again, AI theme, earnings. So earnings acceleration. So here like it made a move as a EP9 million. So this is like example of another like a non-gap kind of a EP9 million kind of a setup, right? Sweet Green, which happened recently, Nova Cure, which is just a reversal bullish kind of a setup. This is something which I'm watching as a delayed reaction EP now, because there's this government takes stake, and after that it is setting up. So this can be like example of that. Best Buy, this is an example of a reversal bullish. Again, you see this. It's a institutional fund kind of a thing, prints reversal bullish, next day, you see. So again, this is a pattern based kind of a trade. Lulu, this is an example of a short where there's a clear catalyst and I waited and like and then shorted. So Hyliion, this is, even if it is a low price stock, I don't get into, but if it shows up in EP9 million, I do a research. So on that day when it showed up, now when it breaks out, I can get into it as it comes into my price points and things like that. So that's what UL, as I told you, all the airlines were going up. This is Velo. Again, this day in the morning, I didn't really realize the catalyst and all earnings was there, but like, and then here it showed up on reversal bullish also. So reversal bullish 53% in 4 days, right? And again, second, this day, like, and I didn't get in, like, and I had a dental appointment, and I really wish I didn't had that dental appointment. I missed 57% move because of that. So Snow, Okta, these are just examples, some of the examples. Like here again, I got into this, got shaken out, right? And I stopped out, enter again, and then the stock made 45% move in a couple of days. So you get, sometimes it just, you get stopped out and then you find another point. Love, I discussed Love with you, SNDK. This is like one of the best stock, but you're not going to get these kind of stocks every day, right? And so this is like a normal momentum burst, right? There are some stocks which continuously give you 30-40% in each swing. So I just have found a way to find those stocks and trade them continuously. Again, this is an example of EP 9 million, where I only bought this because it should have been EP 9 million. I'm at 71%, right? And basically, Dale Lunar. Lunar, again, on the day of Rocket Lab earnings, I said like, this is this. I first bought Rocket Lab and then I bought Lunar, which was showing up in the EP 9 million scan. Wait, this is again like multiple times I traded. So yeah, National Lab, we just had a EP 9 million, but it has EP 9 million multiple times, giving you ability to get in. GLW, I discussed this. On this day, I researched this, okay? So they had missed earnings. They said like their margins are under pressure and all. So I was waiting that, look, and if it gives me an entry, it never gave me a DAP entry, just went straight. So when you look for DAP, sometimes you're going to miss trade because it just doesn't give you an opportunity. So that's it. Pearl, this is that hyper liquid, this thing, I didn't know anything about it. I researched this on this day, and then EP 9 million, it showed up. The gap was very minor. These are the kind of trades which are never going to show up in your EP scan because they are not going to meet that threshold of 10% gap. And then look at this. And then again, second time, look at this. So yeah. So there are a lot of, like Oracle, I traded 3 times in this move. First, second time, each time it was like an EP 9 million.
Great. No, thank you so much. Pradeep, this has been fantastic. Thank you so much for sharing all your process and also the thinking behind the process and how to evolve as a trader. I think that's what's really important. And you put out a tweet, I don't know if it was today or in recent days, about how to get lucky trading and get luck on your favor. Would you mind kind of giving some advice around that, and maybe just advice for traders in general who are watching this, who want to improve, learn these setups and evolve? Yeah.
So there is a very, he died a couple of years ago. There's a psychologist called Albert Bandura, and he is considered among the top 4 psychologists of all time in the world. He was a professor of psychology in Stanford, I think, University. And this guy studied human achievement. And he has this theory of like what makes people successful. And that's the most widely acceptable theory about human achievement or what makes people successful. And he says that there are 2 elements to people's success in life. One of them is the self-efficacy beliefs, that is their own belief about their ability to perform a particular task or do something, right? And basically, but there is a second thing which is equally important. And the second thing is the chance events, which is something which is a fork or something which you didn't plan for, which is not like something completely random thing. And he gives his own life example that he was a Canadian, right? And he came to US to do accounting. He was in an accounting class, second year or something. He was like in a second year of accounting class, and his friend invited him to go to bowling. So the friend had invited other people. So there was one girl he met there. He got smitten by that girl, and that girl was doing psychology. So in order to spend more time with her, he changed his major from accounting to psychology, and he went on to become the greatest psychologist of all time, kind of thing. So there are these chance events or lucky events, so he went on to study luck. And he came out to these chance events, or it's called a psychology. It's a very well-known psychological, I have some background in psychology, so I know this. It's one of the seminal paper in psychology, which is like people's life change through some lucky event, some random this thing, right? And a person joins stock B sites and he sees the setup and he takes that and he goes on to make 100 million. That is like lucky event, right? And it's not like a planned thing, kind of a thing. So then the question is, how do we become lucky? And in order to become lucky, there is this theory called surface area of luck, or the more interaction you have, random interaction, the more the chance that you're going to get lucky. If you're going to be socializing and with only a set of people, or a lot of people I see on Twitter, people say, oh, just go and sit in a cave and you'll become a successful trader. For some one person it might happen, but it is not the way you can. You have to get lucky by talking, interacting with a lot of traders, talking to as many traders, I will give you an example of really, this is real life which has happened in the last couple of years. DEP, which I discussed with you, this is a setup, is not my original idea. Okay. And this is completely how luck happens and how serendipity or complete luck things happen. I was in Costco in the fruit aisle, and one woman comes running and says, "Are you stock B?" I said, "Yeah." I mean, so other people are looking, who is this guy celebrity? She says, "Can I take a selfie with you?" I said, "Okay." Like, and I was so embarrassed, right? And because other people are all looking at me, who's this guy? Like, who's celebrity and who's come to Costco? She says, "I've been watching your video, this and that." And so I started talking to her. She said, like, and I've been trying to do this for 3 years, 4 years. I'm not successful. This is what is blah, blah, blah. So I said, like, "Okay, you're local, come to my office and we'll talk." So she came to the office and talked. Now she has 2 young kids and things like that and all. So she can only trade during a time period and all. So I said, like, you have to find something which will work for you. And because she is local, she just stays like few miles from my house. Multiple times she and her husband, they both trade together now. They came and met me and we had a lot of discussions and things like that. And then we came to this conclusion saying that they can't really do this as a EP or something. So they should look for watch list and operate from a watch list. They went and came back to me after 3 months and said, "Hey, AJ, we have created this process called delayed reaction EP. We go through in the night, create a watch list, watch like this. We only have 3 stocks and we keep like very close stop. And we made some 100% in last 3 months." Like blown apart, right? And they gave me this whole idea. Now that became my setup. Now, what is the probability that you go to buy bananas and you meet some random person who wants to take selfie with you and it ends up into an idea? And that couple have done very well. This happened 3 years ago. They are like, their performance is one of the best I have seen. Like, they are done like so good that if there is a next Market Wizard book, I will definitely recommend it. Then what is the probability of this? This is chance event, right? But if you have a surface area of luck, because I'm visible, I have a YouTube channel, random person meets me and changes things. So people should participate, go to talk to other traders, like go and attend some. I attended that conference in last week. I met most of these people who are in the Market Wizard book. I personally met them, right? And I could interact with them. So you learn so much by personal interaction, right? And somebody has a solution to your trading problem.
Yep. Excellent. Well, Pradeep, like I said, it's always a pleasure talking with you and learning from you. So thank you so much for all you share, both here on Twitter, on your site. We all appreciate it. So thank you so much for your time. To everybody watching, I hope you guys enjoyed immensely. Leave a like down below if you did. Subscribe if you're new to the channel. And Pradeep, thanks again, and we'll be right back. Cheers.
All right, so that concludes day 1 presentations. Thanks so much for being a part of this. Hopefully you guys got a bunch of golden nuggets. And I'd be curious right now in the chat, put what was your favorite quote or biggest takeaway in the chat right now. Let us know if there's, was there a presentation that stood out? Was there a setup that stood out to you? Was there a rule that was shared? Or just, a key quote that, resonated with you? Let me know in the chat. Also, let me know who was your favorite presenter. I learned something new from every single one of them, but let me know who your personal favorite was today. And first and foremost, a huge thank you to the speakers. You guys were fantastic. You guys make this event what it is. So thank you, Jim. Thank you, Peter. And thank you, Pradeep, for sharing your knowledge, your process with all of us so we can learn. All right. So a few quick reminders. Here's how to get the most out of the event. Again, subscribe to the TraderLion channel, join the VIP pass via this QR code, or the link is also in the description. That allows you to access and have access to the resource we'll be creating that brings all the recordings together, adds in notes, adds the slides once they're available, and additional resources as a part of this conference. So if you want everything organized for you in one place, definitely make use of the VIP pass. It's 100% free. And we'll also be doing a bunch of giveaways of master classes, years of deep view. So if you want to be eligible for those giveaways, also, that's a great reason to register for the VIP pass. Also, and you guys were fantastic today at this, engaging in the chat with others and with speakers. That's a great way to get the most out of the event. This one is a great one. Now that day one is over, I'd love to see a bunch of in-depth notes being posted on X, on Twitter about, different presentations. Tag me, tag TraderLion. I'll try to review and respond to as many as I can and retweet them as well. So I want to see a lot of people posting notes. That's a great way to help share the knowledge that we're spreading here today. Then, like I said before, this is being recorded, so feel free to rewatch the presentations on this URL itself. You can go back in time, rewatch Jim, Pradeep, Peter, and again, just make sure your notes are up to date, as good as they can be. So feel free to rewatch all your favorite presentations. And this is just a reminder that to get the VIP pass, you basically have to go ahead and click the link in the description or just scan this QR code. It's 100% free. A huge thank you again to our sponsors, DFU, TraderLion University, and the Trade Lab. For more information on that, click the link, click the relevant links down below in the description, and check out DFU for your trading tool needs, TraderLion University for your education, and the Trade Lab if you're looking for a report and ongoing education as well. Also want to point out that TraderLion University has a fantastic breadth of free resources. So you can scan the QR code right now, create a free account, and get access to ultimate screening guides, a beginner analysis to stage analysis, model books, historical studies of bear markets and corrections. There's so much here. So definitely check this out if you haven't already and make use of all these excellent resources. Also, a reminder that just like the previous years, we're partnering with a great cause. And this year, it's much more personal for me. At least I'll be donating as well. This year, we're partnering with the Michael J. Fox Foundation for Parkinson's research. And for me personally, it's, in memory of my grandmother who passed away this year from Parkinson's, complications of Parkinson's. So this is my grandmother in the middle here, Jackie, my mother, and my aunt here. Parkinson's impacts over 1 million folks in the US. It's a neurological disorder. I encourage you to, look it up, learn a little bit more about it. Likely some relatives or some friends that you might know likely are, dealing with it. It can have very negative side effects and impact, quality of life. And this is a great cause to invest in, pay it forward. If you found value in today's lectures, you've likely learned way more than $10 worth of knowledge. So if you're able to contribute, please go ahead and do so. Or if there's another cause that you want to pay it forward to, go ahead and do that. But if you want to pay it forward to the Michael J. Fox Foundation, this is a very, very reputable foundation that is very highly rated. Go ahead over to the right-hand side. The way to donate should be either above the chat or below the chat. I'm not quite sure. If you have any questions, ask in the chat and we'll point you in the right direction. But again, even $10 is great. So if you found value from the presentations today or previous years' TraderLion conferences, I'd highly encourage you to donate. And like I said, I'll be doing so as well. So thank you guys in advance for paying it forward. I appreciate it. All right. Another reminder to subscribe to the TraderLion channel if you haven't already. Again, we do TraderLion podcasts, in-person interviews, tutorials, webinars, key clips. We've got it all. So we try to approach trading education the right way, focusing on what actually matters, risk management, position sizing, all of that. So if you'd like to support that and support our goal in helping other traders, please go ahead and click the button down below if you're not already subscribed, and help us reach 200K. Again, it's 100% free and likely will help you towards your trading goals. So go ahead and subscribe if you haven't already, and thank you in advance. All right, so some fun stuff here is the schedule for tomorrow. We'll be getting started with a quick intro again from myself at around 9:45 a.m. The first presentation from Ariel Hernandez will be taking place starting at 10 a.m., discussing the puzzle pieces of profitability and performance. This should be really in-depth, really tactical, and cover a lot of ground. So this should be fantastic, especially for people building their systems. Then at 12:20, around there, we'll have Brian Shannon. And let me just, restart here. And let me get back to this. Okay. Then at 12:20, we've got Brian Shannon discussing anchored VWAP and the golden rules of trading, getting into some live analysis as well. That should be fantastic. Then we have, to finish things off, Matt Caruso and Jason Shapiro at 1:25 p.m. Discussing the principles of trading, what really matters, more of a panel discussion. So that should be a lot of fun, a little bit of a different format that we've usually done in the past. And both of these guys are extremely knowledgeable traders. Matt Caruso, top performer in the USIC. Jason Shapiro, a market wizard with over 30 plus years in the business, and fantastic trader. Very different approaches, but you'll see how similar the principles they use are, and it's really just the application of those principles that is different. So that should be fantastic as well. So I look forward to seeing you guys tomorrow. If you enjoyed today, tomorrow's going to be even better. I'll be in the loop via email about the links, all of that. And also I'll be sending a link to a calendar that basically you can set reminders for each of the presentations. So if you haven't already, you can set that up and it'll help you make life easy to basically, you won't have to go search and find for the link. It'll be right there in your calendar when you need it. So again, make sure you guys tune in tomorrow for day 2. Should be fantastic. Thank you guys all for attending. I really appreciate you spending your time with us. And hopefully you guys have gotten a bunch of great takeaways. Again, let us know your favorite takeaways down below in the chat. And I'll see you guys tomorrow. Cheers.